There on reports from Bloomberg that the meeting from the BOJ next week may not be live. They are not seeing enough wage inflation to change their negative rates. Bitcoin also off by close to 4%. Volatility once again in the crypto space. Here's a picture across your futures. A Dow session set for the FTSE 100, pointing lower by 0.2%. But across the benchmark, it is a story of investors holding their ground until some of that data comes through, whether it's the US inflation print or the PMIs later in the week, and of course the central bank action as well. But maybe a bit of pain coming through for the FTSE 100 when we look at basic resources. We'll see how that inflation data out of China ties in to what is happening, of course, with the FTSE 100 and that index, currently down about 0.1%. Another headline crossing on the Japan story, the Bank of Japan story, the yen now weakening 1% against the US dollar. Again, there had been this expectation when we heard from Ueda, the governor, a week or so ago, and other officials from the Bank of Japan, that maybe they were considering making a move at the next meeting that wraps up on December the 19th. The reporting from Bloomberg suggests that is not going to happen. They are not seeing enough wage inflation data or strength coming through in terms of wage inflation to see and feel comfortable that inflation is sustainably towards their target, and therefore it seems, according to Bloomberg reporting, that negative rates will be maintained at the next meeting. Let's get back to these European indexes then. The French CAC currently gaining just 0.1%, a little bit negative on the FTSE 100, but not as much downside being flagged by the futures. We'll see how that evolves, of course, over the trading session. The Spanish IBEX also flat. Germany, similar picture. Again, really waiting for the catalyst to come through later this week. Let's flip the board and see how the sectors are shaping up. And it's worth reflecting on the fact that European equities, of course, reached their highs for the year on Friday. So no big surprise. There's a bit of a breather coming through. Again, across your benchmark, you're flat. Across your sectors, a bit more of an interesting picture. These are the 12 main sectors, and we are looking at a mixed picture, of course, across these 12 main sectors. Health currently gaining 0.3%. Energy also in positive territory. Oil is picking up. We know that the US is looking to refill those strategic petroleum reserves, and oil has picked up a little bit, of course. It's been weak through the last few months. Energy is a sector gaining 0.3%. Basic resources was a drag last week on Friday, and you're seeing that come through again. As I've been flagging leading up to the session today, there was likely to be some weakness, and that's what we're seeing across this sector, down a full 1 percentage point. Again, it's the data out of China, and it's concern about iron ore price and demand that is remaining soft out of that economy. Autos as a sector is currently down 0.2%. Tech is flat. You're seeing a little bit of gain coming through for the banking sector and financial services. Industrials also up 0.2%. It's a mixed picture. Food, one of the biggest losers behind basic resources, currently down 0.3%. Again, benchmark 472 in Europe. Let's get to what is happening then in the central bank picture and get a little bit more insight and analysis, and bring in Sophia Horta-Acosta from our Markets Today blog. And Sophia, if we just look at the lines coming through on the Bank of Japan, the pressure that's coming through for the Japanese yen, and maybe that meeting that some had thought might be live, they might actually take some action when they wrap up on December the 19th. That seems to have been put to one side from the reporting from Bloomberg around how the Bank of Japan is thinking about inflation data.
Yes, exactly. And it really shows you, Tom, the dangers of getting on these one-way bets in markets, and how much excitement there is over a central bank pivot, both in Japan, in the US, and also here in the UK. You're seeing the yen weakness feed through. Actually, we did do a survey earlier this month. This was before the yen trade became incredibly popular. And most economists actually saw the BOJ standing pat in December and actually making a move in April. It seems that that those expectations, at least in markets, are being dialed back. But central banks pushing against market pricing and market expectations is very much a theme for this month.
Okay, let's bring it home. What are market expectations telling us about the Bank of England?
They are pricing in 80 basis points of cuts next year, and Andrew Bailey and his team are not comfortable with that. They keep on saying that it's far too early to even think, let alone discuss cutting interest rates. So we do expect, we're not getting a press conference for this BOE decision, so there might not be too much detail there. But pushing back against, again, the expectation of rate cuts next year will be a theme to watch from the BOE. We do get jobs data tomorrow, and it's a little bit more complicated to read that because it's experimental data, but that could give markets a little bit of guidance. But again, the fact that markets keep on expecting these interest rate cuts from the BOE, despite all the pushback from Andrew Bailey, really shows how entrenched these expectations are for next year.
Okay, so we watch for that pushback from the Bank of England, as you say, as markets pricing, and up to 80 basis points of cuts from the Bank of England. Far less, of course, still from the Fed and the ECB. But you look as well to that jobs data tomorrow, and you flagged this. What are you going to be watching for there? I mean, we see the strength in the US jobs market again, and that came through on Friday. Is it a similar picture here in the UK, or is it starting to crack?
It's starting to crack in that job creation is starting to crack, but wage growth is still very problematic. And that's what makes the picture here a lot more complicated than in the US, where you have a strong labor market, and that's very easy to read. And there is a little bit of slack, and markets are reading that quite positively. But here, you have slack in the labor market in that hiring. We do have data from Reed Recruitment that hiring into the crucial Christmas period has been a lot weaker than last year. But still, those inflation expectations are so entrenched that people are demanding higher wages. So as a central bank, how do you kind of grapple with that? You can't, you have to continue pushing back against expectations of rate cuts, because you're not in a situation where the fight against inflation is done. What's interesting, Tom, and what I will be looking at is how the pound reacts to this, because at the moment, the pound has been strengthening, and it's not so much because there's a kind of stronger economy story here, but it's because the BOE will cut, as you said, interest rates at a lesser extent than the Fed and the ECB, and I think that's the currency story that we have to watch this year.
Interesting. Less about positive economic fundamentals here in the UK, more about expectations the Bank of England will be less aggressive in those rate cuts than maybe some of its counterparts. Sophia Horta-Acosta, thank you very much indeed from our Markets Today blog, running through some of the key themes to be thinking about this week. And get more, of course, from Sophia and the rest of the team. Go to the front page at the Bloomberg UK website, or type TLIV GO on the terminal. Coming up, Anglo American continues its slide after slashing production last week. Your equities on the move with Joe Easton. That is next. This is Bloomberg.
I used to have a data point I used to share that 75% of the people had never heard a phone ringing. Just think about it. I didn't say had never used a phone. They'd never heard it ringing. Today, 75% of the African people have a mobile phone. They use one, okay? And we will do the same with the internet in the next 5 years. We will do it as an industry, as entrepreneurs. All we need is the space, and we need investment support, because we are the best investment case for this in the world.
The top names times and global leadership are on Bloomberg.
What we've just delivered are significant tax cuts. For business, we will be the only major G7 economy, certainly, and even broader than that, where you get a total write-off against your taxes for capital investment. And it comes on top of the fact that our corporation tax rate here is lower than any other G7 economy. That's an incredibly generous regime to attract business investment.
Nobody covers the top global leaders like Bloomberg Television and Radio. Context changes everything. Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.
This is Markets Today. Happy Monday. We're currently seeing across European stocks very modest gains of about 0.1%. We are, of course, 9 minutes, almost 10 minutes into the European trading day. Let's get a check on some of the individual stocks on the move then with Joe Easton. Joe, what is standing out to you?
So we got a big move on the screen here in terms of the pharmaceutical space today. Morphosis over in Germany. This one up around 10% at the moment. They've announced some data from a drug illness trial. They said that it's related to a blood disease, and what it does is it reduces the size of the spleen according to their data, and that stock unexpectedly better than expected, rising as much as 10%, one of the best performers over in pharmaceuticals today. Then we got a couple of miners on the screen. Anglo American can't catch a break, down 19% on Friday, falling another 2% as analysts at BMO downgrade the stock, saying it changes the growth profile of that company, given they cut their production guidance massively in a trader day on Friday. And we're seeing negativity over in Rio Tinto as well. Commodities prices coming down across the board today, giving some weakness overnight in China. So both of those are declining. Another big gainer that we've got, this one over in Norway, is Schibsted, also up around 10%. This is a news media and online classifieds company. They're selling part of their business, according to a statement today, bigger than expected by analysts in terms of the numbers on that one. So that one getting a rise. Some of the utility stocks we brought up, now these three all down. Endesa in Spain, only down a little bit, but Encavis in Germany and also ERG, pretty big moves for those. All three cut over at Morgan Stanley. They go underweight on those ones. Morgan Stanley generally positive on the sector, but they say that those shares are overvalued, so they do recommend selling those. And one that gets a upgrade is Ørsted. This is over at Barclays. Now, the Danish renewable energy firm fell a lot earlier in the year, fell around 40% following a profit warning. Barclays sees value there and does upgrade that one, so we're seeing a small gain for those shares today. I was trying to think of some renewable energy puns, but those stocks having their moment in the sun, maybe that one might work, but I'll move on from that. So Carlsberg, this one gets an upgrade over at HSBC. HSBC prefers beer to spirits. Now, they do say that the spirit sector is weakening. We saw that big warning from Diageo a few months ago, and that's feeding into that. Lonza, meanwhile, this is ingredients, double downgraded over at RBC. They go underperform at that one. That's one of the worst performers we've got across the European market today, down 3% at the moment. It's an ingredients maker that plays into pharmaceuticals as well. And a couple of defence firms and aerospace. Firstly, Kinetic Q in London. JP Morgan is overweight that one, given the rise in defence budgets. And Rolls-Royce is on an unstoppable run, up another 2% today. That one gets a price target raise over at Citi, the highest on the street, worth around 430 pence a piece, according to them. It trades at 296. So lots of upside still in that one, according to Citi, and that one up around 2%.
Joe Easton from our equity team, thank you very much indeed. Another equities in focus, another equity story in focus for us is the spin out of chemicals maker Syensqo. It has started trading at 90 euros after spinning off some Solvay. Big move in the capital markets in Europe, and what has otherwise been a pretty muted year, of course. The company targeting an equity value of around 10 billion euros, 10.8 billion US dollars. That is the redhead crossing the terminal right now. Syensqo listed in both Brussels and Paris started trading one of the largest spin-offs in Europe so far, year to date, with a value at 90 euros, started trading at 90 euros. It's also already been rated a new buy at Equita with a target of 115 euros. We continue to keep across that capital markets story for you. Now, to what is happening, of course, in China, spinning out a little bit in terms of what is happening with the eco data. Growth concerns, of course, in that country amplified once again as consumer prices in the world's second largest economy fall at the steepest pace in 3 years. China suffering from deflation, arguably. Joining us now is Trang Nguyen, Global Head of EM Credit Strategy at BNP Paribas. And Trang, the other line that came through was from this Politburo meeting of senior officials in Beijing, where they dropped the word forceful from their language around monetary policy. Do we assume a less assertive PBOC in 2024, despite the weakness of the data coming out of China?
So I don't think it's less assertive. I think we got the idea that there's going to be a continuation of the same stance when it comes to monetary and fiscal policy. So the reaction function is still reactive. Now, I think it's clear that there's going to be a lack of propensity to be more aggressive in the scale of stimulus measures, and the authorities are careful in terms of committing mistakes that might cause other risks or imbalances.
Is there anything within China high yield that looks attractive to you at this point?
Every time you ask me, I don't have much good news to give you. Right? So we still like China industrials over China property. There's been some easing in financial conditions domestically, which means that there's been some recovery in EBITDA in industrials. But for China high yield property, despite these stimulus measures, we think this will take a long time to recover, and therefore, pre-sales are unlikely to recover completely in the near term.
You have your outlook then for EM credit for 2024.
Yes.
What are the top lines from that outlook as you look ahead to next year?
So a couple of things. One is this idea that there's been a lot of cleansing in EM credit in the past few years. Right? So there's this asynchronous element when you look at the EM credit cycle compared to the DM credit cycle. EM has been in default cycle for over 3 years now. So sovereigns and corporate credit have suffered. And in China, as we've talked about extensively, defaults in the China high yield sector. We've seen defaults in LATAM as well. So there is, and of course, I've also talked about the sovereign defaults extensively also.
But to be clear, you think that default cycle is coming towards the end in
Exactly.
EM?
Yes. So we are emerging out of that. Whereas in DM credit, our indicators suggest that we are still in a late cycle expansion. So there's more pain to be felt in DM credit, whereas EM is emerging out of this.
So how are the markets adjusting to that? Is the window closing then on picking up those high yields, those coupons of what, 7, 8 or above %, or is that starting to be priced in already by these markets that are looking at a slowdown in defaults in EM?
Well, actually, I think we're still in the beginning phase of that.
Right.
So yes, the recovery trade has done very well this year, indeed, and in fact, the outperformers this year have been in CCC and below. But next year, the trade moves away from recovery. It's about the resumption of coupons, right? So we're still going to be talking about very juicy yields next year in the names which are emerging out of distress. And so that's a positive. And if we're right about our rates call and that there's going to be a bull steepening of the rates curve, a rally in the front end means that you lower the bar for inflows to return to EM because you reduce that competition from cash.
So where does that take you? Where are those juicy yields looking most attractive?
For us, it's going to be double B and single B and select parts which are emerging out of distress.
And which regions?
So, well, you know what? We have top picks across the globe, but I'd say that the region that I favor most right now is Latin America. So in corporate credit, as I mentioned, the defaults have already played out in places like Brazil and Mexico, so we like LATAM corporate high yield. In the sovereign space, I think what's really underpriced at the moment or underappreciated is the step up in multilateral support from the IMF. Right? So the beneficiaries there are going to be their double B and single B.
Is Argentina investable? Milei, the new president's been sworn in over the weekend. Is that a country that you're looking at?
Yes. So I think it's reasonable to say that markets are turning more hopeful there. So he's been sworn in. Now, it's not an easy feat for him. He has to carry out a very, very painful front-loaded adjustment to the tune of 5% of GDP, which is not going to make him very popular domestically. But it's a needed adjustment. Now, he's already backtracked on his dollarization agenda, which is also a positive in the near term. And so ultimately, he's in a much better position to negotiate with the IMF than the previous administration. So there are reasons to be positive, but this painful adjustment in the near term is going to be difficult.
Okay, so that's Argentina. And you have what would be, to many, a counterintuitive call on Ukraine, given all the headlines around the challenges of getting funding to that economy, to that government, and to that military as they fight off, of course, that Russian invasion. What makes you optimistic on the funding prospects for Ukraine? Again, as we see Zelensky courting his Western allies to try and unlock that fund flow.
Yeah, so obviously very disappointing for Ukraine. Now, I do think that heading into the U.S. elections next year, that Biden might want to be more aggressive around achieving some of his key agenda items. And Ukraine and Israel are up there, which means he may need to concede in other areas. So that is a risk in terms of the delays in funding, because every month that there are delays, Ukraine is going to suffer on the battlefield. But prices are already in very distressed levels. Bond prices are still in the 20s. Now, there's one positive, which is that the lack of funding has now spurred other conversations, especially those around the use or the confiscation of frozen Russian assets. So we saw in recent days that the UK Foreign Secretary has alluded to potentially a more aggressive stance in pursuing that agenda.
Okay, more broadly, if you step out and have a look at the EM space into 2024, we were talking with Oaktree about refinancing pressures across DM, but in EM, where do you expect those refinancing pressures to be most acute next year?
So I think this might be counterintuitive, but I think it's going to be IG. And this is because in the high-yielding space, we have greater multilateral support. And the one thing, as I mentioned IMF earlier, well, a month ago, we had the executive board approve the 50% increase in quotas. This week, we should have the final board approval. And so a 50% increase in quotas is going to be, it'll be significant for the double Bs and single Bs that rely on multilaterals. It is the IG names that still need to come to market to refinance their maturity wall.
Okay, interesting. Maybe a bit more pressure coming through from IG versus high yield in the emerging credit space. Tran Yuan, with the outlook for EM credit into 2024, Global Head of EM Credit Strategy at BNP Paribas, joining us in the studio. Thank you. Coming up, Olaf Scholz has told fellow Social Democrats he's confident that a budget can be reached in, quote, very difficult talks. We get you an update on the state of the German government's finances. That is next. This is Bloomberg.
There's much oil to be found in the lower 48 at this point, or even in, let's say, Alaska as well, where mostly we know where all the oil is, and there's no more big Permian Basin kind of deposits anywhere?
People have said that over time, and then we've always been surprised. And so the U.S. has been explored more than any other place in the world. I think the industry has a good idea, but technology allows you sometimes to recover things that you haven't been able to before. That's the story of shale. The other one that continues to be a positive story is Deepwater Gulf of Mexico, where we'll go out and drill in a mile or more of water depth and then go down several more miles and find large fields. And the Gulf of Mexico is still relatively underexplored compared to the onshore. So I think there's still room for more discoveries.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Slice through the noise.
Forget the noise, ignore the noise.
Is this just going to be noise?
Just noise.
It's noise versus signal.
Now, more to the point.
What is the lesson or the observation?
This is Markets Today, 23 minutes into your European trading session. And across the European benchmark, you're seeing losses now of about 0.1%. US futures also down, S&P E-minis by a similar level. Let's get to what's happening in Germany, though, and the fiscal front. Germany's ruling coalition will reconvene budget talks today as they struggle to plug a 17 billion euro gap. Chancellor Olaf Scholz told fellow Social Democrats over the weekend he is confident that a deal can be reached in, quote, very difficult negotiations. For more, let's bring in Bloomberg's Oliver Crook on the ground for us, of course, in Berlin, Germany, of course, Germany correspondent for Bloomberg. Ollie, what was the German Chancellor's message then to his party over the weekend?
That's right. He was speaking at the party conference for the SPD, and this is something that happens once every 2 years. And so this is going to be the last one before the next election, which is still some distance away, 2025, but is really an opportunity for Scholz to sort of lay out his agenda going forward amid this budget crisis, right? And he had three sort of major points. The first was that basically the welfare state will not be dismantled as a consequence of this. This is a huge priority for the Social Democrats. The second is Ukraine will continue to enjoy the full support of Germany militarily, financially, and even if other allies start to step away, he says that Germany needs to be prepared to sort of plug that gap. And then the third, of course, is this sort of modernizing of the German economy, trying to get to grips with the energy transition and the fears of deindustrialization, sort of pushing back against that. Again, there was some talk also around the debt brake, right, which is at the center of all of this stuff. Many of the people in the party want to suspend the debt brake again for 2024. That is going to be a challenge. All of them want a reform to the debt brake, and many of them want to do away with it, because how are you going to have all these ambitious plans? The question is, how are you going to pay for them? All of them are expensive.
Well, that takes us to the key question in terms of these discussions and this budget crisis. Ollie, are we closer to getting this finally resolved?
Well, Tom, I mean, Scholz said this over the weekend. He said it's not unsolvable. So I don't know if you take that as a good sign or a bad sign, right? But basically, he went straight from the party conference into the negotiations Sunday. They did not bring an agreement among the coalition. They're ongoing today. And again, there's big promises from the SPD. There's big promises from the Greens. And there's big promises from the FDP. Lindner, the finance minister, does not want tax increases. This is one way to plug the hole. The Greens want to spend massively on this energy transition. So the question is, and of course, you can't offend anyone too much because it could bring the entire coalition down. So the question is, and there might be a bit of a workaround here on the debt brake, could they suspend the debt brake partially again next year, saying that there is still a crisis? That is the war in Ukraine, and the funding that goes to Ukraine, that's 8 billion euros. We're talking about a 17 billion euro hole. That is substantial. So maybe some of that money could be suspended. That would solve some of the problem. But again, nothing is agreed until everything is agreed, and the negotiations are heated and ongoing.
Okay, Bloomberg's Germany correspondent in Berlin, Oliver Crook, with the latest there. Thank you. Coming up, the EU has struck a deal regulating AI. We speak to someone who was on the ground during those negotiations, MEP Eva Maydell. That is next. This is Bloomberg.
Venture capital. It's been volatile. From bank crisis anxiety to AI exuberance, Caroline Hyde and Ed Ludlow chat with the biggest names about the latest tech trends.
Is AI going to dominate the earnings narrative for this sector this week?
I think we're seeing opportunity and potential platform shift that we haven't seen in a long time.
If you're a company today and you're not embracing the changes that are taking place with AI, you're going to be behind.
How do you prove to the investor base that you haven't just tacked on AI to make yourself sexy?
It's very hard to differentiate if you're not experienced with AI.
The startup stories.
We think this is a watershed moment for technology.
Certain categories are more exciting than others. Right now, obviously, generative AI is a category that is very exciting to startup founders, customers, and venture capitalists as well.
So what we are seeing is a new area of opportunities for new founders to come and change the industries that matter.
And the real talk on realistic valuations.
Some of the best opportunities are sitting right in front of us.
How do you discern which ones are good on the marketplace right now?
I think founders have woken up to the reality that taking on more money at higher terms doesn't necessarily play to their benefit in the long run.
How do you actually invest?
Follow the VC money on Bloomberg Technology, the only daily business show dedicated to tech right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West, only on Bloomberg Television.
Welcome back. This is Markets Today. We are 30 minutes into the European trading day. Here are your top stories. The yen weakens after the BOJ says it sees little need to end negative rates this month. The Fed, ECB and BOE confront a market that's pricing in easier policy in 2024. Concerns deepen over China's economic outlook as consumer prices fall at the steepest pace in 3 years. Plus, controlling AI. We're going to speak in the next few minutes to the MEP, Eva Maida, about the hard-fought deal on tech and regulating AI. And the CEO of chip design firm ARM shares his concerns about humans potentially losing control of the machines. Let's check in on these main indexes then on a day when you get the impression that investors are very much waiting for the data that comes through in terms of inflation out of the US on Tuesday, and then of course the decisions from those central banks, the Fed, the ECB and the BOE, amongst a number that come through of course this week. Across your benchmark then, you're currently down about 0.1%. The DAX is off by just 8 points at 16,751. Again, just worth reflecting on the fact that European stocks did get back to the highest levels year to date on Friday. So the downside of 10%, a 0.1%, should be put into that context. The FTSE 100 seeing a bit of a tougher day, tougher session for this UK benchmark, given what's happening in basic resources, and that ties in to the China story. Currently down 0.4% at 7,526 on the FTSE 100. Across your sectors then, let's see how the breakdown is shaping up 30 minutes into your trading day. And it is basic resources where you're seeing some of the heaviest selling pressure, down 0.8%. The deflation concerns out of China and how that ties into some of the big miners listed in the UK, and the FTSE 100 is under the pressure as a result of that, down 0.4%. Some of the other selling pressures coming through from banks, down 0.3%. Personal, the consumption sector is currently down 0.3%. Food is also taking a bit of a hit, down 0.6 to 0.7. A little bit of optimism though coming through for health, industrials and financial services. Technology is unchanged. Financial services are posting gains of 0.3%, so a bit of a mixed session across these 12 main indexes. Talking of tech, let's get to what's happened on the regulatory front over AI then, because after nearly 24 hours of debate, the European Union has reached a hard-fought deal on what is poised to become the most comprehensive regulation of artificial intelligence in the Western world. Eva Maida, a member of the European Parliament from the European People's Party, joins me now from Brussels. Eva, thank you very much for your time. How significant then do you think this piece of regulation, the AI Act, to come out of Brussels is for the sector of AI and for technology in the years ahead?
Good morning, and thank you for having me. Well, the European Artificial Intelligence Act is the first ever comprehensive law to govern AI in the world. So some have went along and called it a historic deal. What we've managed to do is to make sure we lay out a common European vision of how to develop the future of technology, one in which AI is developed in a more democratic, in a more safe, and also in the same time a more competitive way. What we've managed to do is we succeeded to put in place guardrails that would ensure that AI systems are safe, and our democratic values are protected. In the same time, I have pushed hard for what I believe is achieving a more balanced approach between safety, but also openness to innovation.
Okay, well, on that balanced approach then, what were the key sticking points? We talked about the fact this was multiple hours of very fraught negotiations. You were, of course, involved in those talks, in those negotiations. What stood out to you as the main sticking points, and how were they overcome?
So first of all, this has been a 2-year long process. Indeed, the negotiations over 38 hours were very heated, and they were mainly focused on 2 issues. One, how do we address the general purpose AI systems? And the other one was linked to topics related to law enforcement. Because we need to remember that when this legislation was proposed 2 years ago, we lived in a very different world, and the European Parliament legislated the law from the perspective of the internal market and the perspective of the Civil Rights Committee. So this is why this second point was so important from a Parliament perspective, and the first point on general purpose AI is so important for the world, because we are the first to put very concrete guardrails on how to govern this rapidly advancing technology. And I have always stood by the principle that we should not be playing whack-a-mole. Yes, on one hand, these are guardrails that will be regulating systems like ChatGPT or Gemini, but also at the same time, I believe they will be able to stand the test of time and also regulate even more powerful and versatile models that will come in the next years to come.
Yeah. Eva, we get a reminder when we look at what is happening around ChatGPT and Bard and these large language models that are coming out largely out of the US. Just a reminder of just the clout of US technology and to what extent Europe is dwarfed, whether you look at market cap and valuations or indeed the innovations that we are seeing. We do have some equivalents in France with Mistral or Aleph Alpha, in Berlin, in Germany. How do we ensure that the innovation comes through for European tech when it comes to generative AI, given that we're very good at regulating, but maybe not so good at innovating?
Well, first of all, I do very much believe that European leaders at this point understand that AI is the next big thing to power our economic growth and development. And this is why also within this legislation, we have put certain provisions that we believe will support our companies to innovate. First and foremost, we have a very ambitious approach when it comes to regulatory sandboxes. Then we have managed to narrow the scope and tailor it only to the truly high-risk use cases. Another thing that we did is to try to align this legislation with previous legislations in order to create less regulatory burden for those emerging companies. And we have definitely improved the text to support smaller companies, startups, also by including a research and open source exemptions. However, there is an important point. As I said, when we started 2 years ago, those emerging technologies were at a different pace of development. This is why for Europe, it is important, if we want to have our companies to grow and to develop tools and applications that will compete with the rest of the world, then we need to be thinking beyond this legislation. We need to be thinking of supporting tools. We need to be thinking of how to continue developing the capital markets union, how to set up perhaps a sovereign tech fund, how to make sure that we have more strategic legislations like the European Chips Act, of which I also was one of the rapporteurs and worked on, which brings strategy before anything else.
So this is one piece, maybe, of a number of pieces to kind of address the challenges around putting a rules-based system in place for this technology, but also ensuring there's innovation. When it comes to the implementation, Eva, there's 2 to 3 years, possibly, before the rules around these high-risk models are actually implemented. Are you concerned that the innovation will get ahead of the regulation in terms of the time frame?
So we have a timeline that is as follows. First of all, we're supposed to finally vote the law, which would happen in the next few months once all the small technicalities are adjusted. Then after that period, in 6 months, the legislation will be enforced for prohibited practices. In 12 months, the legislation will be enforced for foundational models. And then in about 2 years for the high-risk parts of development of AI, depending whether they're already covered or not from the previous 2 areas. So the way I think about it is that, as I said, it's not playing whack-a-mole. It has to stand the test of time. It's flexible, it's agile, our current approach, particularly when it comes to general purpose AI. We have introduced a 2-tier approach, so only some companies will fall in the more the systemic risk category, that they pose systemic risk for society. And depending on the tier, certain obligations will be part of the way those models should be governed. We also have a European AI office that will have to be set up, and this will help very much with making sure that those obligations are covered. So as I said, it's an agile and flexible legislation. It has moved from its initial proposal by the European Parliament, and we have went into a more balanced way of the way we see this legislation currently.
Okay. Eva Maydell, really appreciate your time and your take on what is an historic piece of regulation from Brussels, member, of course, of the European Parliament from the European People's Party. Thank you. Coming up, staying with the tech theme and more from my exclusive interview with the ARM CEO, René Haas, including how the company will prove essential to that generative AI revolution. That is next. This is Bloomberg.
I think this will probably go down in history as one of, if not the largest financial crimes ever.
I cannot imagine a scenario where $8 billion just disappears.
Bankman-Fried has pled not guilty to multiple fraud charges.
Sam was just too important in the crypto community.
When someone says, I'm going to give $1 billion in the next 2 years, like that catches everybody's attention.
As time went on, their ideas got like weirder and weirder.
I don't think he even had almost a conception at some point that it was wrong or right. I think he just had the mentality that he has to win.
This committee will not stop until we uncover the full truth behind the collapse of FTX.
Sue, Mark.
Are you in? I'm in.
I'm in.
We're in. Will this be the last of its kind? No. This is the nature of capitalism. Get over it.
Business Week Radio. Live weekday afternoons at 3 p.m. Eastern.
We got a little bit of talking.
Come on, are you guys ready?
Harnessing the power of Bloomberg Business Week, Carol Masser and Tim Stanovic bring you the latest news from the worlds of business, technology, politics, and more.
How does the Fed play into this and what the Fed does potentially?
This is so exhausting and this is so all-encompassing.
Listen on Bloomberg Radio and streaming on YouTube and Bloomberg Originals.
From New York City, from London, in Sydney, from Washington, in Tokyo,
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening.
Here's what I'm watching. You do not want to miss this story.
Is there the kind of upside?
This is Markets Today. We are 43 minutes into your European trading day. You are flat across the European stock 600 benchmark. We've got, of course, a lot of data on the docket out of the US and across the Eurozone later this week as well, with those central bank decisions in focus. Also, back to technology, though, and the questions around the evolution of artificial intelligence. The ARM CEO, René Haas, says the UK company is essential to that generative AI revolution, but that doesn't stop him losing some sleep, at least, over the tech's potential. I spoke to Haas exclusively at the company's global headquarters in Cambridge, the UK, of course, and asked him how his role has changed since ARM went public in September.
We've been public now for a few months. Yeah. So I would say I feel like the eyes are upon me a little bit more than they were prior. But on the other hand, I try to think about it in terms of the future of ARM is really not measured in what we are today. It's what we're going to be in a few years.
And how do you balance the demands of investors in the company now, those new investors, and the legacy investors, and of course, Masayoshi Son, SoftBank being the big force, gravitational force there? How do you balance those demands?
So ARM is really a company that is hard to look at quarter to quarter because the technology we're working on today is really technology that's going to end up in products 3 years from now, 4 years from now. So while the financial results are important, they're really the results of strategies we put in place a number of years ago, which were quite successful. What we try to do is just make sure that the investors understand that while the near-term results are very important, it's really also important to really think about the long term and where we're going directionally.
Look, ARM was set up in the 1990s. You've been the building blocks of our digital globe, digital world, digital economy since then. And now we're at this point where we're focused on generative AI, and that is reshaping this digital ecosystem that we now live in, or that we will be living on. What role do you see ARM playing in that transformed digital space in the years ahead?
Yeah, so ARM in the 30-plus years has just been foundational to computing in a way that no other computer architecture before it, and I dare say after it, has been. 70% of the world's population touches ARM today in some way. We were well known for smartphones, and before that, non-smartphones, feature phones, if you will. The ARM of today is not only much more diversified around, as I mentioned before, data centers, automotive, IoT, but now as AI and AI workloads are finding their way into every single application, whether it's your thermostat or your data center, ARM will be there. So I think for us in the upcoming years and decades, ARM will be foundational to everything going on with AI.
So you can assure investors that you will remain, you're essential right now to this digital world that we live in. You will be essential in that generative AI reshaped world in the years ahead. You will continue to play that essential role.
You can't run AI without ARM. It's foundational. And AI is going to find its way into every single electronics device that we use. Again, whether it's the smallest device in your home or the largest data center that sits out in the wild.
Every AI executive that I speak to, whether it's DeepMind or Cohere or Inflection or others, say the scramble for compute is front and center, along with the fight for talent. How do you see that fight for compute going forward?
I do think for the next number of years, we are going to see an increasing demand for more and more compute. Now, I think what's also going to drive is a high degree of need for power efficiency, because these data centers require hundreds of watts, megawatts, up to the gigawatts of type of energy. We don't produce that much energy as a planet. We are having limitations relative to fossil fuels, limitations to sustainable. So a rush to get to power efficiency around these compute models is going to be very, very significant. That's great for ARM because the DNA of our company is around power efficiency.
I want to go back to 2017. You diversified the business. You broke out these 4 different divisions, IoT, cloud, infrastructure, autonomous vehicles. Why did you see that as necessary?
Previous to 2017, we would design a mobile processor and then really attempt to squeeze it or peanut butter it, if you will, into the server space or into the automotive space or into different areas of IoT. It just wasn't sufficient. And we had a lot of questions early on. Well, what's taking ARM so long to be successful in the servers? Many different reasons contributed to that. But one of them was, candidly, we just didn't have the right products. And we were able to create Neoverse. We were able to add custom extensions, things like confidential compute that are necessary for building high-grade data centers. We could put those in the products. And now with Neoverse, we have a world-class competitive entry that you're seeing the benefits of it, whether it's the Microsoft Cobalt or AWS. We had to do that in 2017 because it was clear that these other markets were demanding it, and the software ecosystem needed to be able to support it.
What kind of revenue mix would you need to see to kind of declare a success in that diversification push?
I'm going to declare some modicum of success now. We were over 60% revenue in smartphones, maybe even higher. Prior to this change, smartphones now, while a very large market for us, are about 40% and declining. And our largest growth in terms of revenue are coming from these new markets, as I mentioned, cloud and automotive.
Which of those is most exciting to you? Cloud, automotive? Which has the greatest prospect in terms of driving revenues into the business?
I do think the cloud data center is even potentially more exciting from the perspective of when you layer in the AI component. We talked about all the growth that ARM has seen in the cloud, but now as we're seeing the shift towards AI, a product like Grace Hopper, again, NVIDIA taking their GPU and our CPU and creating the world's best super chip for AI, that wasn't on the roadmap in 2017 when we started because we weren't thinking about the AI market. So I think for us, cloud could be a terrific opportunity.
And what is the market share in cloud that you would be targeting in the years ahead? Do you have a number in mind, Rene?
We're in double digits now, and I always like to say when you get to double digits in our space, you're in the party. Can we get to over 50% over time? I think we can.
Okay, that was more from my exclusive interview with the ARM CEO, Rene Haas. Coming up, it is, of course, a big week for central bankers, to say the least, with Jerome Powell, Christine Lagarde and Andrew Bailey all set to oversee rate decisions. We're going to look at what investors should expect then from the Fed, the ECB, the BOE. For most of them, of course, the last rate decisions of the year. That is next. This is Bloomberg.
Is crucially important, and I think we've moved from this attitude from it's an indulgence, a waste of time, almost an illness that needs a cure.
For something as universally important to human life as sleep, mysteries surrounding its necessity and utility have only just been recently uncovered.
Some of our biggest discoveries were in the 1970s or 1980s, and so it makes it a really exciting field because it seems as though we're uncovering new insights each and every day.
Some scientists are going further to find out how sleep and what happens there can be harnessed to further expand our understanding.
It's easy to memorize things. That makes you smart if you can spit back a lot of facts. But if you want to be wise, if you really want wisdom, you've got to know when and how and why to use that information. And that's what your brain figures out while you're sleeping.
DOJ or other authorities
could face bigger challenges next.
Fed was going to keep rating World Cup. This is a 3
as the economic picture
covering the intersections of Hollywood, Silicon Valley, and beyond.
This is Bloomberg.
Welcome back. This is Markets Today. We are 53 minutes into your European trading day. You are flat across the European benchmark, the stock 600 across your main indexes. The FTSE 100 here in the UK is having a bit of a tougher day, down 0.3%. Basic resources being a drag, but over in France, the CAC 40 is actually posting gains of around 18 points on the French index. One company to mention, and this is big in terms of spin-offs, is Solvay, which has spun off Syncesco, which is a chemicals maker, and it's listed both in Paris and in Brussels. Solvay is down around, 70%, in fact, the last time I checked, checking it now, down 70% on Solvay, which is listed also in Brussels. But this, of course, is part of this spin-off that is going with Syncesco, which is a chemicals maker carved out, of course, from that larger parent company. So we keep across that story for you as well. Let's talk about what's happening macro, though, across these markets. And the BOJ really jumped to our attention with these lines around the December meeting. Let's bring in Ven Ram for the analysis, who joins us from our M Live team. And the reporting from Bloomberg, Ven, suggesting the BOJ officials, well, December, the meeting that wraps up on the 19th, it's not going to result in a change to negative policy because they're not seeing enough progress in terms of wage inflation. What do you make of these lines?
Absolutely, Tom. Even since last week, it was kind of clear that the BOJ wasn't going to do anything this week when they meet next week. And I think investors should just relax and go home for the year end because they're not going to do anything just yet. As you mentioned, there is not enough sufficient evidence in Japan as yet from the wage negotiations that, there is sufficient and sustainable inflation that the BOJ keeps hopping about. We are going to get an inkling of that only in the spring when the Shunto wage negotiations take place. Until such time, it's very unlikely that the BOJ is going to do anything. The yen has run up almost 4% in the past 4 weeks. That's in overbought territory now. So some of that froth has to come off as investors take money off long yen positions going into next week's meeting.
Ven, which of the other central banks making decisions this week? Of course, the BOJ is later, but this week, the Fed, the ECB, the BOE, which of those central banks is most likely to surprise, do you think?
I don't think any of them will actually surprise because, if you look at the Fed, they're going to be cautious. We saw the unemployment numbers, the jobless rate ticking lower for November, which is completely in the opposite direction the Fed wants it to be. So the Fed is going to reiterate the message of higher for longer. The ECB, the ECB obviously has the biggest headroom, but even then we are talking about core inflation that is north of 4%. So they're going to be cautious as well. As for the BOE, you've got services inflation and core inflation nudging 6 and 7%. Those are not compatible with rate cuts anytime soon. So I don't think we are going to see a surprise from any of them, actually.
Okay, Ven Ram from our Markets Live team with the analysis that you need ahead of this big week for central banks. Thank you. Remember, you can get up-to-date analysis from Ven, the rest of the team, of course, by going to MLIV Go on your terminal. That is it for Markets Today. You can get insights from us, the rest of the team, of course, on the front page of the UK website or by typing TLIV Go on the terminal. The Pulse is next. This is Bloomberg.
Steve's ability on the course may not be etched into any record books, but following him around, it's clear that it's not for lack of trying.
Jeez.
We were constantly hustling behind him as he caught up with executives in the portfolio companies and reminisced with former and current players.
He's a day trader. He taught himself, self-made day trader. Yeah. And so he's on the bus after a game in New England, and he's day trading on the bus, and Bill Belichick sees him and cuts him on the spot.
In many ways, it's a convention, right, of the people that I don't see maybe once a year. And so it's kind of all come together. My firm, our charity, our fundraising efforts, and then the friends that are around. My dad and my brother, it all happens right there as a confluence of all these parts of my life that have found its common center.
This is Bloomberg News Now.
News when you want it at the touch of a button.
Another volatile day on Wall Street. We're seeing big moves.
All eyes on Capitol Hill as Democrats and Republicans prepare.
Today's job numbers casting doubt on the Fed's next move. Inflation remains front and center. And that's news when you want it with Bloomberg News Now. Get it 24/7 on the Bloomberg Business app, Bloomberg.com, and anywhere you get your podcasts.
Bloomberg News Now. Context changes everything.
Good morning. This is Bloomberg Surveillance on TV and radio.
Welcome to Bloomberg Markets, China Open.
Good morning, everyone, and welcome to the Pulse.
This is Bloomberg Technology.
And welcome to Balance of Power.
This is Bloomberg. And market movers. This is The Pulse with Francine Lacqua.
Well, good morning, everyone, and happy Monday. Welcome to The Pulse. I'm Francine Lacqua here in London with the conversations that matter, and here's what's coming up on today's program. Investors brace for this year's final rate decisions from the Fed, the ECB, and the Bank of England. It does feel like a finale. Plus, Bloomberg understands the BOJ will not rush into scrapping the world's last negative rate later this month. Two major challenges for the British Prime Minister, Rishi Sunak. He faces a grilling later today on his performance as Chancellor during the pandemic, while also trying to quell a rebellion against his government's latest plan to deport some asylum seekers to Rwanda. And the EU reaches a deal on what's expected to become the most comprehensive regulation of artificial intelligence in the Western world. So first thing is first, as we were just saying, it's a pretty crazy week in terms of central bank policy, so watch out for any nervousness out there from the markets. Now, I think we have three pieces of big data, and that's just in the U.S. Then we look at the ECB and, of course, the Bank of England. So it's a pretty event-packed week. Yen also extending some of the losses to 1%. This is after Bloomberg reported that the BOJ officials see little need to rush into scrapping the world's last negative interest rates, as they haven't seen enough evidence of wage growth that would support sustainable inflation. Now, joining us for more on this, Bloomberg MLive's Ven Ram and Maria Muniki, a fund manager at M&G Investment Management. Thank you both for joining us. Wow, what a week we're going to have. So get some sleep now. Actually, it's too late. It's Monday. I hope you had a relaxing weekend, because we have a lot of central banks. And so the markets, I guess, are on tenterhooks.
Absolutely, and I think it's a very live week in terms of what we've observed in the past few weeks, because the market is very attentive to any data point. This is on the back of central banks telling us that they are very much looking at this data, now having increased rates quite significantly. But what we've been through in the past few weeks, I think, is pretty incredible already. I mean, we got to the end of October when investors were very much focused on this high for longer narrative, and that has brought a lot of volatility to both fixed income and equity markets. And just in a few weeks, past the 31st of October, we've seen an incredible rally across really all assets. But then this speed of increase in prices seems to have somehow slowed in anticipation of this data. We've already seen a little bit last week with the US labor market coming in, a little bit of a surprise for some investors. So it's very interesting for us to see, what the data would look like in the next week, and how will investors react to that.
Yeah, and then I guess the most important bit, I mean, I know we have 3 live meetings, and I know it's a big deal, but actually it's also the data coming out of the US that will really focus or not the minds of traders.
Absolutely, Francine. So I think that, the Fed is in this position where the disinflationary narrative is pretty much running according to their projections. If you look at their PCE, core PCE projections, they kind of line up with what they forecast for the end of 2023. But what is not kind of playing out to their satisfaction is the resilience of the labor market. The Fed thinks that the jobless rate should have been around 3.8% average for this year. But we are only averaging 3.6% this year. And last week, the jobless rate actually went lower. That means that the labor market is continuing to be resilient, and to bring that labor market into balance is going to be the Fed's focus. And therefore, they are unlikely to say, you know what, we sanction 2 or more rate cuts next year. They're not going to do that. They're going to push back on that notion. And that is what is going to weigh on the markets this week.
Yeah, but Maria, I mean, a lot of central banks have been pushing back all the time on this because market expectations are really getting ahead of it. So what does it mean for portfolio building on when you're expecting the Fed to cut rates?
Yeah, I think we've been in an incredible journey, and all the way through, from summer to October. I think with these yields increasing across really sovereign markets, across curves as well, there has been an opportunity to add diversification across duration. So not only adding to US dollar duration across the curve, but also if you look at European and sterling government bonds, they've also followed into this increasing trend of yields. Since then, we've seen quite a strong retracement in the month of November, and I think there has been an opportunity to take some profit on this diversification and on this expansion of duration across portfolios. At the same time, I think there are some vulnerabilities right now, given how fast prices have moved across sovereign curves in just the past few weeks, how much sentiment has shifted, how much more interest rate cuts we have now priced in for next year. There is a bit of vulnerability there to these yields. However, if we expand the time horizon a little bit, in a medium-term sense, if you are expecting some slowing in the growth pattern, I think there is some value there also from a diversification standpoint. So I think it's important to be able to play these markets both in a tactical way, so in a shorter-term view, as well as in a medium to longer-term view, recognizing that there is more value overall in fixed income now than there has been for a long time.
And then this goes back to the main question, which actually there's a brilliant piece on the Bloomberg Terminal today, which, look, when the Fed starts cutting rates, is why are they doing it? Is it just because inflation goes down and so they can afford to, or is it because we're at risk of a recession? So then how quickly do you think we'll see rate cuts, and will it be with an okay economy?
I think that we are likely to see any rate cuts in June, sometime in June. I think anything before that, I mean, if you look at the way the economy has been resilient, if you look at the jobless rate, if you look at job creation, if you look at the economic growth, which we had a stellar third quarter growth, let's not forget that. So, there is nothing in the economy that is going to compel the Fed to come out and cut rates. They want to see 2% inflation. We are at 3% something now. So until it is clear to them that we are going to get converged to 2% inflation, they are not going to cut rates, which to my mind is going to be sometime around June.
Marie, again, what does that mean for some of the investor belief? There does seem to be, like you're suggesting, a kind of, market pricing in cuts or pricing in a recession. Then we have stronger than expected data. And I don't know whether it's the pattern that can continue into 2024, but it seems like we've been living this pattern for the last 18 months.
I feel, the expectations of rate cuts that we see now, they're in a way different from the ones that we were seeing at the beginning of the year, when there was a lot more expectation around a slowing economy and fears of recession. Throughout this year, some of these fears have been abated because of better data, better earnings. And it feels that now it's more about, inflation has been coming down, so it gives the central banks a space to reduce interest rates without necessarily affecting growth. But as we were saying, there is the issue of the labor market still being very strong, and also the fact that growth is really not faltering that much. At least data is still mixed, especially if we look at leading versus lagging data. Lagging data is better. Leading data, it's a little bit softer. We had some indication, for example, from the beige book, which is a more anecdotal evidence that there is some slowing down in economic growth also in the US. So I think this is something that we really have to be very cautious about into the next year, because of the many and several, lagged effects of monetary policy, as we very well are aware of. But it feels that the rate cuts that are priced in now, they're not so much about growth scare, and this is evidenced by what equities have been doing at the same time, which is having some very strong performance.
Ven, so Bank of England, ECB, who has his hardest job this week? Dun dun.
I think. I think that the BOE is a harder job because, the markets are kind of thinking they're going to cut rates by August. But, if you look at core inflation in the UK and if you look at services inflation, they're nudging around 6 and 7%. That is hardly compatible with a situation where you're going to go for rate cuts. So Andrew Bailey and his team have a very strong pushback coming this week saying that, look, you know what? Rate cuts are not even a matter of discussion just yet. It's too premature to discuss that. And they will have a harder time. The ECB, of course, has seen the disinflationary narrative take hold, and they have more headroom to cut rates if they must later, early next year.
And is this, Maria, why you like emerging market local currency bonds? Probably, because they offer attractive real and nominal yields compared to some of the developed markets.
Yeah, I think we've had a positive view on emerging market sovereign bonds in local currency for quite a long time. And in particular, we entered this year with a significant position in these bonds, which has really helped performance throughout the year, as they surprised the markets and performed really well. They remain attractive from a nominally real yield perspective compared to some of what we observe in developed markets. Although developed markets are becoming more attractive, especially after the latest phase of interest rates increase and yields moves that we have seen on the back of that. I think where we find slightly less value at the moment from an asset allocation perspective is on credit, and that's also because of credit spreads are not particularly elevated at the moment. Overall, the all-in-all yield is attractive, but there's always that component of your risk element through the credit spread and the interest rate element of it, and the credit spreads is what to us looks more neutral, still open for opportunities from a more stock picking standpoint, but from an asset allocation standpoint, potentially less interesting at the moment.
Maria, thank you so much. Maria and Ven there, MLive's Ven Ram, Maria Muniki, a fund manager at M&G Investment Management. Now, we're also getting some breaking news out of Macy's. Now, remember, we told you earlier on today, it actually got a $5.8 billion buyout firm. So pre-market Macy's, you can see up 20%. Now, the offer is from Ark House Management and Brigade Capital Management, and it's at a 20% premium to Macy's closing share price on Friday. So you see it's matching up. It's almost getting 21% in today's trading session pre-market, and it comes as the chief executive prepares to hand over the reins to Bloomingdale's chief executive, Tony Spring, in February. So a lot going on with some of the U.S. retailers. Coming up, a make or break week for the UK Prime Minister Rishi Sunak. We'll tell you why when we return. This is Bloomberg.
I used to have a data point I used to share that 75% of the people had never heard a phone ringing. Just think about it. I didn't say had never used a phone. They'd never heard it ringing. Today, 75% of the African people have a mobile phone. They use one, okay? And we will do the same with the internet in the next 5 years. We will do it as an industry, as entrepreneurs. All we need is the space, and we need investment support, because we are the best investment case for this in the world.
The conversations that matter, the insights you need. This is The Pulse, and I'm Francine Lacqua here in London. Now, Germany's ruling coalition will reconvene budget talks today as they struggle to plug the 17 billion euro gap. The Chancellor, Olaf Scholz, told fellow Social Democrats over the weekend that he's confident a deal can be reached in, quote, very difficult negotiations. Now, for more, let's get to Olli Kruk, Bloomberg's Germany correspondent, who's in Berlin. So, Olli, we're all kind of waited for, we're trying to figure out whether they can actually muddle through. What is the Chancellor's message to his party?
So, of course, he had the party congress of his party, the conference that really sets out the agenda for the party over the next 2 years, which will be the last one that they have before the election in 2025. And it goes in the midst of this crisis, which has really hijacked the whole conversations. But he really laid out three things. And first of all, that the welfare state will not be dismantled as a result of the budget talks. The second, Germany will be an unflinching supporter of Ukraine militarily, financially. Even if other countries step back, he was saying that Germany is going to step in. And then the third, of course, is modernizing the economy, dealing with the climate crisis and the energy transition and all the fears of deindustrialization. The problem for Scholz is that all three of these priorities cost a lot of money, and that is something that the German government is rather short on. So, of course, the debt brake came up. Many in the party want to see, almost all in the party want to see reform of the debt brake. Many of them want to see it suspended again next year to deal with this crisis, and many of them want to get rid of it entirely, which, of course, as we know, is very difficult given that it's in the Constitution.
So, Olli, is the budget crisis any closer to actually being resolved?
Well, that sort of depends. It depends how you feel about what Scholz said about it over the weekend. He says it's not unsolvable, which does not exactly strike, a huge amount of optimism. But basically, he went straight from the party congress into negotiations again yesterday. They continue today. They haven't got there yet. And it's one of these things, one of these classic European things, whereas nothing is resolved until everything is resolved. And he's got coalition partners that, in addition to his big ambitions, have their own big ambitions. The Greens need a lot of money for subsidies for the energy transition. And the FDP, they're going to stand in the way of anything like tax hikes, which of course would raise revenue. The question is, could they, for example, there's 17 billion missing. Could the 8 billion that goes to Ukraine, could they suspend the debt brake and call a crisis there temporarily? That would fill part of it. But again, the negotiations are very heated. And if this goes very, very badly, and this is not the best case, this could bring down the government. And this is why this is such a delicate negotiation.
It certainly is. Olli, thanks so much, Germany correspondent in Berlin, Oliver Crook. Now, it's a dangerous week for the UK Prime Minister Rishi Sunak due to face a grilling from Britain's COVID inquiry over decisions he took during the pandemic when he was Chancellor. Now, at the same time, Sunak is trying to quell a rebellion within his own Conservative Party over his latest push to deport asylum seekers to Rwanda. Well, let's discuss all of this with Lizzie Burden, our UK correspondent. So, Lizzie, first of all, good morning. Sunak also appears today in front of the COVID inquiry. What can we actually expect from this?
Well, just what he wanted when he wanted to warm up for the Rwanda plan vote tomorrow. He's going to have to talk about Eat Out to Help Out, which you remember was this programme to try to subsidise meals so that people will get back eating out at restaurants, boost hospitality. Now, the danger for Rishi Sunak is that he's tarred with the same brush as his former boss Boris Johnson, and already the accusations are swirling that he's Dr. Death, that he cared more about the economy than the health of people, that this helped to spread the virus. The former Health Secretary Matt Hancock called it the Eat Out to Help Get the Virus About scheme. So ultimately it comes down to a question about Rishi Sunak's judgment, and when he's so far behind Labour in the polls, it's not something that he wants to happen.
Yeah, and he also has a major test on immigration tomorrow to see whether actually he has his party behind him.
Yeah, and as you say, he's got rebellions potentially from both the right and the centre on this. You've already seen the question posed to him repeatedly about whether this is going to be a back me or sack me moment, a la John Major. And over the weekend, Michael Gove, the Levelling Up Secretary, said that Sunak isn't planning to call an election if this vote goes south. But look, he's already lost a key ally in the Immigration Minister, Robert Jenrick, over this, because Jenrick says these rules don't go far enough to deter illegal migrants. The irony is, our reporting shows this wasn't even Sunak's brainchild. He wasn't even behind this idea in the first place, and yet now it's one of the key policies in his top 5 priorities, and it could be his downfall.
But because he feels he needs to deliver, actually, to make a difference to the polls.
Exactly. And this is an issue that the Conservative Party at least thinks that really, really matters to voters. But today you're expecting to have meetings of both the European Research Group of Eurosceptic MPs, but also the One Nation Conference of more moderate MPs. And so it's a difficult one in terms of the vote, because if you've got 100 MPs on both sides, the numbers are Sunak needs to get below 56 abstentions or 28 votes against. So we'll have to see how persuasive the whips have been over the weekend. And David Cameron, the new Foreign Secretary, has been out to bat trying to get people behind the Prime Minister's plan.
Lizzie, thank you so much. Lizzie Burden there, our UK correspondent, with the very latest on the Prime Minister. Now, we'll have plenty more, of course, throughout the day on this as the COVID inquiry also starts. Coming up, Russia's Vladimir Putin speaks with the Israeli Prime Minister, Benjamin Netanyahu. We'll bring you the top lines from that call and the latest on the Israel-Hamas conflict. That's next, and this is Bloomberg.
There's much oil to be found in the lower 48 at this point, or even in, let's say, Alaska as well, or mostly we know where all the oil is, and there's no more big Permian Basin kind of deposits anywhere?
People have said that over time, and then we've always been surprised. And so the U.S. has been explored more than any other place in the world. I think the industry has a good idea, but technology allows you sometimes to recover things that you haven't been able to before. That's the story of shale. The other one that continues to be a positive story is deepwater Gulf of Mexico, where we'll go out and drill in a mile or more of water depth and then go down several more miles and find large fields. And the Gulf of Mexico is still relatively underexplored compared to the onshore. So I think there's still room for more discoveries.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
The conversations that matter, the insights you need. This is The Pulse, and I'm Francine Lacqua here in London. Now, Cigna is planning a $10 billion buyback after calling off Humana talks. You can see on the back of that, pre-market, Cigna gaining 9.1%. Now, let's also get to some of the other top red stories on the Bloomberg terminal. And Israel's prime minister has hit out at Russia's cooperation with Iran in a 50-minute phone call with President Vladimir Putin. Benjamin Netanyahu's office says he's strongly criticized what he called the, quote, dangerous cooperation between Russia and Iran, while relations between Israel and Russia have been strained since the Hamas attack in October. Egyptians began voting yesterday in a 3-day-long election, with President Abdel Fattah el-Sisi all but certain to win a third term, even as the North African nation grapples with its worst economic crisis in years. Now, the most pressing issue for Egypt's electorate is a soaring cost of living, with inflation running at almost 35% after 3 currency devaluations since early last year. And Javier Milei has been sworn in as Argentina's president. In a message to the nation, he warned Argentines will have to endure additional pain while he works to pull the country from an economic crisis. Well, Milei has pledged spending cuts and said the economy will worsen before turning around. The leader's cabinet picks triggered a rally in the nation's dollar bonds and stocks. And U.S. retailer Macy's has received a $5.8 billion buyout offer from an investor group. The offer from Ark House Management and Brigade Capital Management is at a 21% premium to Macy's closing share price on Friday. It comes as the chief executive, Jen Jeanette, prepares to hand over the reins to Bloomingdale's chief executive officer, Tony Spring, in February. Now, the uproar over the handling of anti-Semitism at some of the U.S.'s most elite universities continues to grow, with Harvard's president, Claudine Gay, facing mounting pressures in the wake of Saturday's resignation by University of Pennsylvania President Liz Magill. Well, the leaders of Harvard, Penn, and MIT have been slammed by lawmakers and business leaders over their responses to whether calling for the genocide of Jews is against school policy. And the UK's COVID-19 inquiry is turning its attention to Rishi Sunak, with the Prime Minister set to testify today. A key question will be whether the then-Chancellor's plan to shore up the hospitality sector during the pandemic may have spread more disease. Now, Rishi Sunak's Eat Out to Help Out scheme attempted to get people back out and spending money during the summer of 2020. Tomorrow, the Prime Minister also faces a difficult vote in the House of Commons on his plan to deport asylum seekers in Rwanda. Now, Macy's is jumping some 19% after the company got a $5.8 billion buyout offer. Now, the offer from Ark House Management and Brigade Capital Management is at a 21% premium to Macy's closing share price on Friday. Again, it comes as the chief executive prepares to hand over the reins. So we'll have plenty more, of course, on that throughout the day. Coming up, with global growth expected to slow, we'll discuss the outlook for refinancing and deals with Joseph Oughourlian, the chairman and managing partner at Amber Capital. A lot of talk, of course, is on central banks. We have a pretty event-packed week. We have central banks from the Fed, BOE, and ECB meeting this week. This is Bloomberg.
This will probably go down in history as one of, if not the largest financial crimes ever.
I cannot imagine a scenario where $8 billion just disappears.
Bankman-Fried has pled not guilty to multiple fraud charges.
Sam was just too important in the crypto community.
When someone says, I'm going to give $1 billion in the next 2 years, like that catches everybody's attention.
As time went on, their ideas got like weirder and weirder.
I don't think he even had almost a conception at some points that it was wrong or right. I think he just had the mentality that he has to win.
This committee will not stop until we uncover the full truth behind the collapse of FTX.
Sue, Mark.
Are you in? I'm in.
I'm in.
We're in.
Will
this be the last of its kind? No, this is the nature of capitalism. Get over it.
The top names in global leadership are on Bloomberg.
What we've just delivered are significant tax cuts. For business, we will be the only major G7 economy, certainly, and even broader than that, where you get a total write-off against your taxes for capital investment. And it comes on top of the fact that our corporation tax rate here is lower than any other G7 economy. That's an incredibly generous regime to attract business investment.
Nobody covers the top global leaders like Bloomberg Television and Radio. Context changes everything. Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question. Great question. Best question I get all night.
Bloomberg, top experts, great questions.
Investors brace for this year's final rate decisions from the Fed, the ECB, and the Bank of England. Plus, Bloomberg understands that the BOJ will not rush into scrapping the world's last negative rate later this month. Two major challenges for the British Prime Minister, Rishi Sunak. He faces a grilling later today on his performance as Chancellor during the pandemic, while also trying to quell a rebellion against his government's latest plan to deport some asylum seekers to Rwanda. And the EU reaches a deal on what's expected to become the most comprehensive regulation of artificial intelligence in the Western world. So good morning, everyone, and welcome to The Pulse. Happy Monday. I have to say, a lot of traders and investors need to brace themselves for what is going to be a crazy busy week. I'm Francine Lacqua here in London. So the global economy is set for its slowest growth since the dot-com bubble burst, apart from the crisis years of 2009 and 2020. That's at least according to Bloomberg Economics, which expects the world's GDP to grow 2.7% next year from 3.1% this year. Now, it's also forecasting a shallow recession in the U.S. from now until early next year. Let's discuss what this all means for refinancing and deals with Joseph Ougourlian, Chairman and Managing Partner at Amber Capital. Joseph, as always, thank you so much for coming on. You give us a good perspective on actually where you find value, what kind of deals you're after, and where you see the fault lines. I'm surprised that the economy keeps on holding up, right? I mean, markets seem to price like a correction, the end of the world, and then after 6 months, earnings are resilient, the economy is fine, and we go back to drinking our coffee. Like, what's going on?
Well, I think there's a number of things that are happening. You know, there's still the impact, the delayed impact from all the fiscal stimulus that we had during the COVID period. Typically, you know, fiscal policy has a lag of 12 to 24 months after, it's being announced. So you're still seeing some of that impact, hit the economy. You also have, the consumer and the corporates to some extent that have sort of piled up a lot of cash, that have delevered during that period, and their balance sheets, in many cases are very resilient. In the case of the corporates, they've refinanced at much lower rates. In the case of the consumer, they've increased their savings dramatically, and they're using those savings. Also, the consumer is in great shape because unemployment is on its lows. So all these factors have contributed to the resiliency of the economy.
Joseph, if I told you a year ago that this would have happened this way, how difficult would it have been to predict? So I know you look at models, you send some great charts also that you're looking at in terms of earnings resilience, but actually how incredible is it that we are December 2023 in a pretty strong position, having gone from like 0 interest rates to at least 5%?
It's very surprising. I mean, I confess that, not a lot of pundits would have bet that European markets would have done so well. But then again, the earnings of European corporates have been incredibly resilient, and now we're starting to see, the prospect of the central banks having, reached peak interest rates. So I think that's good news for the markets in general, and particularly, those European markets look incredibly cheap. They've been hit very badly post the Ukraine invasion. People saw Europe as the last place you want to be invested in because, it had no commodities exposure. The Russian gas was being, pulled away, and, interest rates were going up with inflationary pressures. I think all of those themes have receded. Europe has survived, now 2 winters, or, it's going to survive a second winter without the Russian gas. Interest rates, have had an impact on the economy, but it's not been as bad as people thought. And last but not least, there's all these factors which I mentioned around fiscal policy, around the resiliency of the consumer, which have really helped.
Yeah, and you argue, and actually I hear this a lot from chief executives that come on the show saying, sometimes we're not, say, the European chief executives, we're not fairly valued because for U.S. investors, Europe is very far and we're close to Ukraine, so they kind of sell off everything. And I don't know whether you see any truth in that, but you also argue that basically, if you look at the best earnings revision globally last year, Europe's at the front. So, are you expecting stock prices to follow that?
I think so. I think you're gonna have a switch from growth to value stocks. That will help European stocks typically because Europe is seen as more of a value market than the US, which is more sort of tech led. But I mean, technology has outperformed so much for so long that certainly the one benefit of interest rates going up is that it should favor, it should put more, shed some good light on value names.
So where do you want to be invested in Europe? And is it, companies or sectors that also have exposure to China and other emerging markets?
Well, we like Southern Europe because Southern Europe is less exposed to China, because Southern Europe is more exposed to all those consumer trends which I've mentioned, and because Southern Europe is very cheap. We're also like, a number of value sectors like, financials, both banks and insurers, look very interesting. They look very cheap, and they're really pricing a recession scenario, which we don't really see, or a deep recession, which we don't really see at this point. There's probably going to be a slowdown that will lead, the central banks to decrease interest rates. But, some of those cyclical names, in Europe are being priced, like there's going to be, Armageddon tomorrow. And I think that's excessive.
So, again, why are banks so cheap? And I know a lot of the reasons behind it is we don't understand actually how they'll grow, how they make money, like the business models. And a lot of them in Europe have been put into question.
Look, I think that's a sector that's been out of favor for such a long time. And I think that, there's been this massive increases in earnings with interest rates having gone up. And the market is sort of staying on the fence, sort of saying, okay, I'll reprice you some, but I won't give you, a multiple re-rating. So really, all that you've seen with the performance of the financial stocks is really, due to their earnings. But the multiples are still incredibly low. You're talking 5-6 times earnings for the sector as a whole. And in Southern Europe, you really have like deep value names that, by the way, they have what people call, deposit beta much lower than the northern banks, meaning that they've not had to pass on those interest rate increase to their depositors. And that means that they've been able to sort of, see extra profits for longer.
So are you expecting, corporate deals also to step up? I mean, this is one of the big questions. Actually, we don't know what private markets do, and that could also impact. There's a mismatch between also in the public markets, what people want to sell for, and actually the buyers, I guess, how much they're prepared to acquire it for.
That's absolutely right. I think, during those periods, especially since the Ukraine war started, I think a number of transactions have been put on hold. And they've been put on hold because, the sellers still are hanging on to the prices that they saw recently. And then the buyers were sort of saying, well, hang on a second, I need to understand, what's in store. And with the resiliency of the economy, the belief that there's going to be a soft landing, and also, I mean, I'm not sure when central banks are going to be cutting rates, but it seems now, consensus that interest rates have peaked, both short-term and long-term, and that gives some kind of visibility. That gives you, something to hold on when you're sort of working on valuations of companies.
But Joseph, what do you say to people that push back? And I know the U.S. is not a beacon of stability politically, but when people look at Europe and say, look, there's so many different countries, look at what happened in the Netherlands, look at the budget talks in Germany, look at some of the pushback in Italy, that it's difficult to navigate because you have, a lot of political uncertainty.
I think you've got a lot of political uncertainty pretty much everywhere in the world. I think you've seen some pretty extreme moves in politics, and that includes the U.S. What you've also seen in Europe, and that's been, you know, very positive for European markets, is that even politicians that look fairly extremist, like Mrs. Meloni when she got into power, they very quickly changed their tone. You know, Millet, I think you were talking about Millet, and the fact that, you know, ever since he got elected, he sort of changed his tone, and he's become a bit more moderate. I mean, he needs to implement radical changes in Argentina if they want to get out of their predicament. What you're seeing with a lot of those politicians is that to get elected, they tend to go towards extremes. But when they get into power, it's a different story.
What do you make of the UK right now? I don't know whether you're looking at possible investments.
The UK looks incredibly attractive as a value proposition. There's still, you know, enormous challenges since Brexit. You know, inflation is higher than in the rest of Europe. The central bank doesn't seem to have, you know, things, you know, pretty much under control. And so, you know, we're more on the fence with the UK market than we would be for the rest of continental Europe.
Joseph, as always, thank you so much for coming on. Joseph Ougorian, their chairman and managing partner at Amber Capital. Coming up, we'll be hearing from the chief executive of chip designer ARM on his ambitions to dominate the AI space. That exclusive interview is next, and this is Bloomberg.
Steve's ability on the course may not be etched into any record books, but following him around, it's clear that it's not for lack of trying.
Jeez.
We were constantly hustling behind him as he caught up with executives in the portfolio companies and reminisced with former and current players.
He's a day trader. He called himself self-made day trader. Yeah. And so he's on the bus after a game in New England, and he's day trading on the bus, and Bill Belichick sees him and cuts him on the spot.
You know, in many ways, it's a convention, right, of the people that I don't see maybe once a year. And so it's kind of all come together. My firm, our charity, our fundraising efforts, and then the friends that are around. My dad and my brother, it all happens right there as a confluence of all these parts of my life that have found its common center.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
ARM chief executive Rene Haas says tech firms with exposure to China run a very fine line these days. Now, he spoke exclusively with Bloomberg's Tom McKenzie on how the chip designer is navigating the geopolitical tensions surrounding the sector.
We've been public now for a few months. Yeah. So I would say I feel like the eyes are upon me a little bit more than they were prior. But on the other hand, I try to think about it in terms of the future of ARM is really not measured in what we are today. It's what we're going to be in a few years. I spend most of my time thinking about where ARM is going to be 3 years from now, 5 years from now. So on one level, yes, it's changed because the eyes are on us. We're a public company. We have to meet our expectations. We have to do exactly what we say we're going to do. But on the other hand, I'd like to think maybe not so much change because I'm thinking about 5 years away, just like I was before the IPO, same way I'm thinking about it today.
And how do you balance the demands of investors in the company now, those new investors, and the legacy investors, and of course, Masayoshi Son, SoftBank being the big force, gravitational force there? How do you balance those demands?
So ARM is really a company that is hard to look at quarter to quarter because the technology we're working on today is really technology that's going to end up in products 3 years from now, 4 years from now. So while the financial results are important, they're really the results of strategies we put in place a number of years ago, which were quite successful. This is when we created our Neoverse product line for the servers, we created our automotive product lines, and you're seeing those things really come to bear. So for us, what we try to do is just make sure that the investors understand that while the near-term results are very important, it's really also important to really think about the long term and where we're going directionally.
ARM was set up in the 1990s. You've been the building blocks of our digital globe, digital world, digital economy since then. And now we're at this point where we're focused on generative AI, and that is reshaping this digital ecosystem that we now live in, or that we will be living on. What role do you see ARM playing in that transformed digital space in the years ahead?
Yeah, so ARM in the 30-plus years has just been foundational to computing in a way that no other computer architecture before it, and I dare say after it, has been. 70% of the world's population touches ARM today in some way. We were well known for smartphones, and before that, non-smartphones, feature phones, if you will. The ARM of today is not only much more diversified around, as I mentioned before, data centers, automotive, IoT, but now as AI and AI workloads are finding their way into every single application, whether it's your thermostat or your data center, ARM will be there. So I think for us in the upcoming years and decades, ARM will be foundational to everything going on with AI.
So you can assure investors that you will remain, you're essential right now to this digital world that we live in. You will be essential in that generative AI reshaped world in the years ahead. You will continue to play that essential role.
You can't run AI without ARM. It's foundational. And AI is going to find its way into every single electronics device that we use. Again, whether it's the smallest device in your home or the largest data center that sits out in the wild.
Every AI executive that I speak to, whether it's DeepMind or Cohere or Inflection or others, say the scramble for compute is front and center, along with the fight for talent. How do you see that fight for compute going forward?
I do think for the next number of years, we are going to see a increasing demand for more and more compute. Now, I think what's also going to drive is a high degree of need for power efficiency, because these data centers require hundreds of watts, megawatts, up to the gigawatts of type of energy. We don't produce that much energy as a planet. We are having limitations relative to fossil fuels, limitations to sustainable. So a rush to get to power efficiency around these compute models is going to be very, very significant. That's great for ARM, because the DNA of our company is around power efficiency.
Well, that was the ARM Chief Executive, Rene Haas, speaking exclusively with Bloomberg's Tom McKenzie. Now, sticking with AI, and the European Union has reached a hard-fought deal on how to regulate artificial intelligence this weekend. It's poised to become the most comprehensive regulation of AI in the Western world. Now, for more, let's bring in Bloomberg's Aggie Cantrell in Berlin. Aggie, good morning. So what's the significance of this deal?
Yes, Francine. So this is something that the EU has had in the works since 2021. And then, of course, this year, with all the new developments in the AI space, it has become front and center for a lot of companies, what they're focusing on. And after 37 hours of negotiations last week, they finally hashed out a deal. Some things that were particularly interested in it was that there was a real tension, especially with France and Germany as nation states being concerned about how this regulation might limit their own AI startups, their own efforts to develop AI. And it was about trying to strike that balance between regulating this technology and not limiting innovation. And something else that I thought was interesting is that part of the real high-risk options for AI, like, for instance, biometric data, facial scanning, and the like, that was something the European Parliament last spring had actually rejected and said that this shouldn't be permitted, live face scanning technology. But this time around, the nation states got their way a little bit to have a compromise which said essentially that that sort of technology could be used for national security purposes.
Aggie, so what will this mean for the likes of ChatGPT, but also Google's Bard?
Yes, so that's the real focus, Francine. Of course, there are these high-risk elements to AI, and of course, there are these biometric data and collection that is part of that. But the real focus of this AI Act was what this is going to mean for those huge AI models like the likes of ChatGPT and Bard. And so the conversation there was really about transparency, about making sure that they have policies in place for the acceptable use of their technology, and also have some seriously detailed summaries about how they are able to train those models, what data they're using, and also how they're respecting copyright law around that. These are huge issues that aren't really tackled yet when it comes to how companies like OpenAI are developing their ChatGPT models and other large language models. That this is a real concern for a lot of people who own the copyright, or there are concerns around what data, what potentially personal data is being used to train those models. So this might be a real heavy lift for companies like OpenAI to make sure that they adhere to it. And also the fines, if you don't, are pretty significant. 35 million euros for violations, or 7% of the company's global turnover.
Aggie, thank you so much for that great reporting. Aggie Cantrell, there, Bloomberg's tech reporter in Berlin. Coming up, Volodymyr Zelensky heads to Washington. This as the U.S. President Joe Biden's request for more military aid hits a snag in Congress. We'll bring you the very latest, and this is Bloomberg.
I used to have a data point I used to share that 75% of the people had never heard a phone ringing. Just think about it. I didn't say had never used a phone. They'd never heard it ringing. Today, 75% of the African people have a mobile phone. They use one, okay? And we will do the same with the internet in the next 5 years. You know, we will do it as an industry, as entrepreneurs. All we need is the space, and we need investment support, because we are the best investment case for this in the world.
Business Week Radio, live weekday afternoons at 3 p.m. Eastern.
We got a little bit of talking.
Come on, are you guys ready?
Harnessing the power of Bloomberg Business Week, Carol Masser and Tim Stanovic bring you the latest news from the worlds of business, technology, politics, and more.
How does the Fed play into this, and what the Fed does potentially?
This is so exhausting, and this is so all-encompassing.
Listen on Bloomberg Radio and streaming on YouTube and Bloomberg Originals.
The conversations that matter, the insights you need. This is A Pulse. I'm Francine Lacqua here in London. Now, Ukraine's Volodymyr Zelensky is headed to Washington for talks with the U.S. President Joe Biden. Kyiv is facing a second winter of war amid uncertainty over continuing aid for the country from Western allies. Now, for more, let's bring in our very own Maria Tadeo, Bloomberg's Europe correspondent, who's in Brussels. Zelensky, Maria, is doubling down on diplomatic efforts. What is he actually hoping to achieve?
Yes, he is, Francine, and it's been a while since we last saw President Zelensky really hit the road. He was yesterday in Argentina. He was invited by the newly elected Argentine president. We know he met with a number of Latin American leaders, and today he heads over to the United States. Tomorrow he will speak with President Biden, but most crucially, too, we believe he will also address a number of U.S. lawmakers making the case for funding for Ukraine. This has become, obviously, the biggest concern for the Ukrainian government. By now, it's clear that this issue has become a political football in the U.S. It has been incredibly politicized over the past few weeks, and now it is connected to whether or not there's more money and funds that would go into the U.S. border security. So that has become very connected with the national politics. For Zelensky now, this is about reinstating his message that he needs the Biden doctrine to work, that Ukraine will now head into another year of war, most likely, and the funding, the weapons, and any support they can get from the U.S. administration is crucial. If not, the country, quote, could be in mortal danger. That is on one side when it comes to the funding, and the other one, again, is the political message. The Ukrainians, Francine, they're very aware that Ukraine, as a story, perhaps, has been sidelined by some of the geopolitical events. It is palpable they're not the center of the geopolitical action, and they want to re-inject momentum into their own struggles.
So funding, as you say, is becoming a sticking point everywhere, also in Europe. So where are we on that?
Yes, Francine, and this week we're heading potentially for a train crash. Remember, there is a European Leaders Summit at the end of the week. There are two major points on the agenda. One is funding for Ukraine pegged to the European budget. The other one has to do with the accession talks for Ukraine, which is the green light for the country to one day join the European Union. We know it's not going to be overnight, but it is nonetheless a strong political signal for the country. There is one man in particular, and that is Viktor Orban of Hungary, who has said he is not going to accept either. He has a veto like any other country, and we could see that play out on the Thursday, Friday. I spoke to a European official who told me he could not remember a European summit where so much, so consequential, depended almost entirely on one man. The Ukrainians today repeated that if Ukraine does not get clear signals from the EU, that would be a colossal failure at a time in which it's obvious the country is heading yet again to a very difficult winter.
Yes, so important. Maria, thank you so much. Maria Tadeo, our Bloomberg Europe correspondent, joining us from Brussels. Now, very quickly, this is what Macy's doing. It got a $5.8 billion buyout offer. So the offer was about 21% higher than what we had at the closing price on Friday. So pre-market, you can see Macy's is just matching that, gaining 19%. We'll have plenty more market details. This is Bloomberg. Nurturing also can come from men, and it's one of the qualities, I guess, that you found in your mentors that also pushed you up. Do we need even more nurturing post-pandemic? Is the way that we talk with employees going to change?
I think talent becomes the single biggest differentiator of a successful entity versus an unsuccessful entity. So you've got to do everything possible to hire, train, retain, put your arms around talent. I mean, you really got to focus on your talent. In the past, it's always been give them money, show them that they have an upward mobility and can make even more money, and that's the only reason people come to work. I think post-pandemic, we are seeing more and more people say, I have to worry about me as a person. I have to worry about my family. I want to worry about my well-being, my mental health. So we've got to start encompassing people as holistic humans as opposed to a tool of the trade, which means that we have to engage with them head, heart, and hands, not just head and hands. The heart has to be engaged. So we have to show more empathy, show that we care, that they're citizens of the community, they're members of the family, and all of those have to come into consideration as we help an executive or an employee. Be an employee and be a person of the community and the family. The stakes are higher.
This is Bloomberg News Now.
News when you want it at the touch of a button.
Another volatile day on Wall Street. We're seeing big moves.
All eyes on Capitol Hill as Democrats and Republicans prepare.
Today's job numbers casting doubt on the Fed's next move. Inflation remains front and center. And that's news when you want it with Bloomberg News Now. Get it 24/7 on the Bloomberg Business app, Bloomberg.com, and anywhere you get your podcasts.
Bloomberg News Now. Context changes everything.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.
Good morning from our world headquarters in New York. I'm Manus Cranny.
And from our studios in London, I'm Danny Berger. Welcome to Bloomberg Brief. Let's set your agenda.
Defining 2024, investors brace for this year's final rate decisions from the Fed, the ECB, and the BOE. Meanwhile, the BOJ says it sees little need to end its negative rate policy this month, pushing the yen lower. And Macy's gets a buyout bid from investors as Cigna walks away from the talks with Humana. 3 days that shifted the narrative in dollar-yen. You're looking at this flash crash, which Ueda provoked because he said the end of the year was going to be more difficult. Here we go. We have managed to take back 75% of the rally in yen. But how is the options market positioning itself? That's the question as we see the Bank of Japan officials really try to push back on our over-enthusiasm in the FX market for a stronger yen and a ripping off the band-aid of YCC and NIRP. More on that in a moment. To the bond market, you looked at 2 years popping by 7 basis points on Friday. The U.S. labor market just defies any sense of slowdown, with the unemployment number at 3.7%. Rates tick ever so slightly higher this morning on the short end of the curve. More importantly, what does the Fed do to arrest this runaway train that the market is? It's baying for cuts. The key focus will be on the summary of economic projections. The dot plot could be the opportunity for the Fed to re-grasp the narrative. The growth and inflation numbers, really what you're looking at is a curve which has moved from bear steepening to bull steepening, and that, according to the MLive team, will continue. There is your dollar-yen. 75% of the move is undone. And there was a mini flash crash in Bitcoin. It was down by 7.5% this morning. It really did get trashed. Deleveraging, few wobbles ahead of the Fed's inflation data this evening, but it has put on 150% of a rally so far this year. Keep an eye out. You'll also see a 10-year auction in the bond market later on today. Danny.
It's a good Monday when Manus has a Bitcoin check for us. Even though it's down, I still count that as a win. Look, this equity market, even though you had that hotter than expected jobs figure came in, I guess the equity market decided that it meant there was definitely going to be a soft landing, so it rallied instead of saying, okay, maybe we won't cut as much. Regardless, we ended the week higher, so that was another 6th week of gains, the longest winning streak since 2019. We give that back a little bit this morning, ever so slightly, but Citi and Oppenheimer today coming out with notes saying that they see a record high in U.S. stocks come 2024, joining the bulls like Deutsche Bank. Macy's also adding to gains this morning. That's up some 16% because of a potential deal. We're going to talk about that throughout the show. The CSI 300, this was an interesting one. At one point today, it was down 1.6%. We had really poor inflation data come out of China. That flips as China ETF volume spikes. The thinking is potentially the national team is coming in to buy that. State-owned enterprises are dipping into the ETF market. So that bolsters us. But Hong Kong stocks, those didn't rally, giving you an idea of where the sentiment is. The gap between the CSI 300 and Hong Kong is the widest in a year. Finally, European equities unable to post gains this morning. The miners are doing poorly, again, off the back of that China data. And again, there's this question of what will the ECB do this week? Man, as Bloomberg surveyed a bunch of economists who think that Europe is going to be going into a recession. But here's the thing. We get the flavor. Within 60 hours this week, Manis, we're going to get 60% of the world setting rates.
Yeah, but can they push back against what the market has? I mean, the markets, as far as U.S. rates are concerned, Danny, may have trimmed back their view on where we go with policy from like 130, 135 basis points. Let me show you what rate decisions look like this week, the choreography. It will be about the Federal Reserve and Jerome Powell. What's he going to do in terms of re-grasping that narrative as the market, as I say, is baying for rate cuts? The short end of the curve just took a little bit of a pop, up by 7 basis points. Lagarde already very much trying to guide the market to steady itself. And then the Bank of England really has perhaps the toughest job of them all. You've got a big note out from Goldman Sachs saying actually they're raising their sterling target to 130 because as the others cut more aggressively, it may well allow an outperformance on sterling. We can raise that question, of course, with our next guest. Danny.
Well, there's some irony today, Manis, because you have all these central bank decisions, but the one bank that doesn't have a decision this week is in focus. It's the BOJ. The yen is falling both versus the euro and the dollar after 1 point last week, surging 4%. Bloomberg reporting says that they see little need to cut at the end of this year. Joining us now is Jane Foley, head of FX strategy at Rabobank. I mean, Jane, did we all just get over our skis? Or are we in for more yen bull disappointment?
You know, I think we are in for more disappointment. And to be honest, if you listen very carefully to what the Bank of Japan is saying, then I think you probably wouldn't have got carried away with this trade last week anyway. You know, the Bank of Japan have made very, very clear. Ueda was talking about this just a month or so ago and saying, you know what, they would rather inflation overshoot, because inflation were to overshoot, well, then they can hike interest rates, which is actually would be a really nice scenario for them. And the danger is if they go too quickly on removing their policy accommodation, they could just be back where they've been for decades of, you know, the disinflation, deflation. They don't want to do that. They want to be very, very slow. And okay, what they're waiting for is, of course, this more news on this virtuous cycle, which is domestically driven inflation coming from wage hikes, which go into consumption, which then goes into profitability, and then it becomes this cycle. So that's what they're waiting for. We had good indications this year that there is life in that cycle. They are beginning to see that, but they want to wait for more. So the process of removing that accommodation is going to be slow.
So, I mean, Bloomberg Economics have popped out their numbers as well. Core inflation will be 3% this year, drops to 1.8% in 2024. Again, missing the target. And then in 2025, I mean, who the heck knows where any of us are going to be in 2025? 0.9%. As you know, I mean, sometimes you really sort of feel like going like that with the outlooks. But here's the question from an FX perspective. If it is going to be more glacial, a move than we think, then does yen still remain a funding currency of choice? And in that case, what is it sold against, or what outperforms relative to yen?
Well, I think it will still be a funding currency. I mean, to be honest, to be long of the yen is pretty expensive. So from that point of view, yes, it will be. But of course, most other central banks, or several other, the G10 central banks, you know, will be cutting interest rates in 2024. So you do have a shift in the dynamic. Now, you know, again, you mentioned sterling before. I think sterling or the UK, the Bank of England, is going to be one of the last of the big central banks, certainly, to cut interest rates. So, you know, that might become a little bit more of an interesting trade. But I think for now, you know, even if you look at dollar yen, you know, I think we could go a little bit higher given last week's move before perhaps over the next year or so we begin to become lower again on dollar yen.
Well, speaking of the UK potentially needing to push back against this narrative of cuts for next year, I mean, the Fed, the ECB potentially needs to do that too. But do markets care? Are markets even going to listen to central bankers this week if they do push back against that narrative?
Well, that's a really good question, because I would say that if we go through right to the beginning of this year, that the market most of the time has been disregarding Fed guidance. I mean, if you go back to the beginning of the year, the market was thinking, the Fed's going to be cutting interest rates before the end of 2023, and the Fed was no. And through, up until we got to about July, when the higher for longer narrative really did take hold, the market was disregarding the Fed, and we could see more of that again. However, what I would say is that the Bank of England, I think, has been a little bit more consistent with their message, saying the labour market is too tight, it's too soon to be talking about interest rate cuts, and the market has bought that to some degree. Sterling's been performing really quite well, and I think there's good reason for that. CPI inflation in the UK is higher than it is in either the Eurozone or the US, so it's quite an easy sell, and I think from that point of view, that sterling, well, it has outperformed the euro in the last few weeks, and I think actually sterling's got further to go as well.
I mean, it's interesting when you look at the market construct, the CFTC data, they've gone net bullish for the first time since September. But is that more dollar weakness than it is sterling strength? It sounds as if you're talking up a bit of a sterling bid book there.
Well, again, I think this is relative, and actually I think the more interesting story is euro sterling.
Okay.
Because I think, the euro has got, certain issues, and I think from that point of view, I think the euro will be sold during the course of the next year, both in interest rate cut dynamic, but also because of the competitiveness issues that the Eurozone is facing, particularly, of course, with Germany. And I think if inflation can be kept under control, actually, they could probably do with a period of a weaker euro.
Actually, to that point, the dollar weakness that we've seen, does it take into account what other central banks are going to be doing? And is that going to flip? Are we going to stop concentrating on just the Fed for defining the direction of the dollar next year?
I think we're going to have to, that's a matter of fact. If we see other central banks coming through with more dovish implications, then the market will have to take consideration of that. And I think you're quite right. If we go back, to the CPI data that we had a month ago from the US, the market thought, US inflation is weaker, let's sell the dollar. Not, let's sell the dollar, but actually what we're going to buy, because these other central banks might be cutting interest rates too. And I think we will have a lot more of that coming through in the next few months. And I think we've already begun to see that already.
I mean, we've done the survey as well about the propensity for recession in Europe. I don't think that's the headline. I think probably it is more from an FX perspective. To what extent will the ECB maybe even outcut the Fed next year? And in that case, what does that do to the euro?
And I think you're quite right. I mean, if we look at the growth forecast, for instance, if we look at the European Commission, just a few weeks ago, it revised down again its forecast for GDP, both for the Eurozone and for the EU. Now, even that, we still think that's optimistic. We think the Eurozone is probably in recession right now, and that if we look ahead to next year, well, the outlook for Germany in particular is still, really quite sluggish. And if you look at some of the more specific data, if you look at the surveys of confidence, for instance, in the chemical sector, a big energy user in Germany, it's still extremely low. I think there's this real issue with Germany having to make up for the fact that it no longer has cheap energy, and the price that's having on a lot of German companies. I think it's still really relevant to talk about the threat of deindustrialization, for instance, in Germany. I think the EU are really focused on competition and improving the competitiveness of the region. And I think the Inflation Reduction Act is still an issue. It's almost like it's almost like the Pied Piper to some big energy users in Europe. Come to the US. Come here. And I think there's a real struggle potentially for the Eurozone over the next couple of years to adjust to this more expensive energy regime.
So I've set a trend then, Jane. Have I got on the plane, came to America and believed
Amanda says the reason why everyone's investing in the U.S. That's the reason. That's the real reason.
Yeah, confidence. Give me a green card. I'll leave you with this thought, right? You know who's the most unreliable boyfriend of them all now? It's Ueda. I mean, he managed to spark a 4% rally in the currency in the space of 2 days. That is not the volatility that the Bank of Japan wants.
At least the market's moving on the Bank of Japan. At least there is one bank that's left that can still move markets.
And just to say, it's a big day. Jane Foley back in the house, back in the seat, back in the studio. You're never to be on Zoom again on this show, Jane Foley. Thank you very much. Jane Foley at Rabobank with her calls on the markets. Danny, let's get some of the other stories that are trending. On the Bloomberg terminal this Monday morning, the former President Donald Trump says he will not testify in his New York civil fraud trial today, backtracking on a statement last week in which he said he would be taking to the stand. The lawsuit alleges that the Trump organization inflated assets for more than a decade.
Javier Milei has been sworn in as Argentina's president. In a message to the nation, he warned Argentinians have to endure additional pain while he works to pull the country from an economic crisis. Milei has pledged spending cuts and said the economy will worsen before turning around.
And in an exclusive interview with Bloomberg, the CEO of Arm weighed in on potential downsides to artificial intelligence.
That we lose control of the machines. I think to some extent, and the hows are still very much being debated, obviously, of having the fail-safe mechanisms in place that humans can override the systems. That is probably the single largest thing that I think and worry about, is that if the machines can be, or the algorithms, or whatever's being generated can be developed in such a way that there is no fail-safe mechanism, that it can be overridden by a human, that's what worries me.
Well, coming up, we have your Monday morning deals. Macy's is offered a $5.8 billion buyout, while Cigna says no deal after calling off its pursuit of Humana.
Pressure on Ivy League schools continue as the leader of Penn resigns over her comments on anti-Semitism. This is Bloomberg.
This will probably go down in history as one of, if not the largest financial crime ever.
I cannot imagine a scenario where $8 billion just disappears.
Bankman-Fried has pled not guilty to multiple fraud charges.
Sam was just too important in the crypto community.
When someone says, I'm going to give $1 billion in the next 2 years, like that catches everybody's attention.
As time went on, their ideas got like weirder and weirder.
I don't think he even had almost a conception at some points that it was wrong or right. I think he just had the mentality that he has to win.
This committee will not stop until we uncover the full truth behind the collapse of FTX.
So, Mark.
Are you in?
I'm in.
I'm in.
We're in.
Will this be the last of its kind? No. This is the nature of capitalism. Get over it.
This is Bloomberg Brief. I'm Manus Cranny in New York, Danny Berger alongside me in London. So Macy's is on a roll pre-market. The retailer received a $5.8 billion buyout from Arkhouse and Brigade Capital. The investor group offering 21% premium to Macy's closing share price on Friday. As you can see, we're right on the money. Dasha Afranasia joins us with the rationale behind the deal. Of course, they own Bloomingdale's, which is just literally at the back door of this building. I've helped the Bloomingdale sales so far. But what's the rationale? Fact of the day. What's the rationale for the deal? Good morning.
Good morning. So Macy's owns Bloomingdale's, but it also owns a lot of its real estate. And at a conservative estimate, that real estate is worth $6 billion. So that's less than the market cap and actually even less than the offer price here. So I think given that one of the private equity investors that's bidding is a real estate investor. I think the expectation is that value is unlocked there. So that's sort of what they mean when they say it can achieve more as a private company than as a listed one.
I mean, but what can they? Why couldn't Macy's just do this themselves? What is the difference of having a PE owner?
Well, I think it's the leverage, which obviously is a lot more challenging given that interest rates have gone up, and it's also basically being able to sell off the real estate, unlock this value, and not really have to depend on kind of innovative ways to get Macy's to compete with other retailers. So, you know, online, you know, an incredibly challenging landscape, which saw Macy's actually downgrade its outlook this year, and also last quarter, sales fell 7%.
I just can't help but wonder, Manus, does this like change the name of the Macy's Thanksgiving Day Parade? Does it become like private equity parade and it's just, you know, bankers and like gilets walking around?
Yeah, I just can't, you know what, I actually can't see private equity continuing to sort of pay for the parade. It's sort of like, what can you cut, what can you trim? Because that's the sort of the historical reference point. One other one, Dasha, we want to touch on is Cigna. Now, they're going to walk away from Humana. I mean, they put a lot of effort into this deal. It was going to be one of the biggest deals of the decade. It means a bigger buyback. That's what they're going to do with the capital. But just put the context around this for us.
Absolutely. So it has been a lot of work already, but they were concerned that it would be even more work, particularly given the regulatory environment. So sources spoke to Bloomberg and said that they're pretty confident that the deal would get through, but that it could add extra expense, extra time, and they weren't willing to deal with it, particularly in the context that Humana's share price has fallen almost 10%. And that there was a gap between the expectation of Humana shareholders and what Cigna was willing to pay at that point.
All right, one deal on, one deal off. Dasha, thank you so much for joining us. That's Bloomberg's Dasha Afanasieva. Hey, Manus, one other deal that happened over the weekend that's probably worth mentioning. Those talks between the PGA and PIF for the PGA Tour Fenway has now entered the chat. They are entering the final talks. This includes Fenway, it includes Steve Cohen's family office, and Mark Lazary as well. So potentially a third party in all of this.
Yeah, I mean, you know, they have form in sport. Fenway, obviously, owner of Liverpool Football Club. They got the Pittsburgh Penguins and the Boston Red Sox. And I suppose after Henry Kravis and George Roberts dropped their pursuit of a stake in the PGA, you know, this left the door open. Steve Cohen is pervasive in terms of deals. So let's see how that finishes. I think they sort of said they're still going to continue to negotiate with the PIF. Maybe that'll make Rory McIlroy a little bit happier. Quick snapshot. We were looking at Macy's, looking at Cigna. This is what they are. 21% was the premium on the Friday close. They're still just shy of that at the moment, but no real indication that the deal won't go through. And Cigna up 12.83%. Those are your stocks to watch this Monday morning on Bloomberg Brief.
I used to have a data point I used to share that 75% of the people had never heard a phone ringing. Just think about it. I didn't say had never used a phone. They'd never heard it ringing. Today, 75% of the African people have a mobile phone. They use one. Okay? And we will do the same with the internet in the next 5 years. You know, we will do it as an industry, as entrepreneurs. All we need is the space, and we need investment support, because we are the best investment cases for this in the world.
Slice through the noise.
Forget the noise, ignore the noise.
Is this just going to be noise?
Just noise.
It's noise versus signal. Now, more to the point.
What is the lesson or the observation?
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
It's Bloomberg Brief. I'm Manus Grenny in your Danny Berger alongside me in London. So let me ask you, have you got a Christmas? Well, you won't have a Christmas tree, but I went
actually do, but it's like this big. It's like a teeny tiny little Christmas tree.
I want to give you East New York versus West New York, okay? So I live in the east side of New York, and your average Christmas tree at Whole Foods was $70. Now, of course, then when I went there on Saturday, there were none left. So I was a little bit distressed. So then I was in Chelsea, okay, over on the west side. $200 for a Christmas tree. I said to your woman, do you think I came up the Hudson in a sort of a bathtub? And she just looked at me. She just didn't really understand the analogy. $200 for a Christmas tree. That is just
inflation's
nuts.
out of control. The Fed needs to hike again, Manus. That's craziness. I also love this. It's like you have to be wealthy to like celebrate Christmas or something like that. I've also got a problem, Manus. We're multi-faced here on Bloomberg Brief, but of course the tradition for Hanukkah, you spin the dreidel, you hand out gelt, which is those chocolate coins. Manus, we've got an issue too. Chocolate is the most expensive since the 1970s. This is the cocoa futures. There's been a drought and then massive rain in West Africa. Last month, Mondelez, which makes Oreos and Toblerone, said they're going to be raising the prices. Okay, this is a problem for everyone, regardless of what religion you are, because, Manus, this will not stop me from eating an ungodly amount of chocolate this holiday season. I will not stop, even if it costs me, you know, the shirt off my back.
Chocolate is agnostic, and because I'm Irish and I track the price of potatoes, let me tell you, you've got soaring prices of potatoes for Christmas because of heavy rain. So you go, just look at commodity go, prices for potatoes, staple for Christmas roast, etc. They're soaring. There you go. Spuds and chocolate. You don't need either of them. We don't know what spuds and chocolate are on this show.
I was going to say, is there like a potato Christmas dish that I'm unfamiliar with?
Don't invite me to your house for any kind of festival celebration this Christmas. Anyway.
As long as it's not turkey again for Christmas, then I'm happy. Okay, Manus, coming up on the show, we're going to be talking about the pressure on Ivy League schools. This is Bloomberg.
venture capital. It's been volatile. From bank crisis anxiety to AI exuberance, Caroline Hyde and Ed Ludlow chat with the biggest names about the latest tech trends.
Is AI going to dominate the earnings narrative for this sector this week?
I think we're seeing opportunity and potential platform shift that we haven't seen in a long time.
If you're a company today and you're not embracing the changes that are taking place with AI, you're going to be behind.
How do you prove to the investor base that you haven't just tacked on AI to make yourself sexy?
It's very hard to differentiate if you're not experienced with AI.
The startup stories.
We think this is a watershed moment for technology.
Certain categories are more exciting than others. Right now, obviously, generative AI is a category that is very exciting to startup founders, customers, and venture capitalists as well.
So what we are seeing is a new area of opportunities for new founders to come and change the industries that matter.
And the real talk on realistic valuations.
Some of the best opportunities are sitting right in front of us.
How do you discern which ones are good on the marketplace right now?
I think founders have woken up to the reality that taking on more money at higher terms doesn't necessarily play to their benefit in the long run.
How do you actually invest?
Follow the VC money on Bloomberg Technology, the only daily business show dedicated to tech right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West, only on Bloomberg Television.
DOJ or other authorities
Could face bigger challenges next.
Was going to keep Green World Cup. This is a three.
As the economic picture.
Covering the intersections of Hollywood, Silicon Valley, and beyond.
Welcome back to Bloomberg Brief. I'm Manus Cranny in New York.
And I'm Danny Berger in London. Here's what you need to know. Defining 2024, investors brace for this year's final rate decisions from the Fed, the ECB, and BOE. Meanwhile, the BOJ says it sees little need to end its negative rate policy this month, pushing the yen lower. And Macy's gets a buyout bid from investors as Cigna walks away from talks with Humana. All right, your check on markets, because we are on track for the longest weekly gaining streak since 2019. Sure, we come down in S&P 500 futures, down about 0.1%, but we got those hotter than expected job figures, and the market decided, at least equity investors, ever the positive ones, say that means we're going to get a soft landing, not that we're going to cut less, so we can keep rallying. We have both Citi and Oppenheimer saying that we're going to have a record high in U.S. stocks next year. Again, we are lower this morning. China, those equities moving up 0.6%, a turnaround from the day. At one point, they were down 1.6%. That turnaround was based on higher ETF volume, the thinking going that perhaps state-owned enterprises are coming in, they're buying. The state-backed team is nibbling around the edges. Finally, Europe, that also moves lower, unable to sustain gains, Manus, because we had weaker China data. Inflation was bad, so miners are falling along with all the other metals.
Well, Danny, the Bank of Japan, Ueda caused his own flash crash in dollar-yen last Thursday. That's where you saw that massive drop in the dollar by 4% and a rally in yen. Well, we've retraced nearly 75% of that because the Bank of Japan lacks the proof of sustainable inflation. So maybe Ueda becomes the unreliable boyfriend of all the central bankers. We've retraced 75% of that flash crash, and is the market just a little bit too ahead of its skis? Certainly the bond market was ahead of that jobs report that we had on Friday. So you are looking at yields this morning just trade a little bit higher on the bonds. We popped by 7 basis points on Friday. Unemployment is just burning like a fire in the United States of America, an unemployment rate of 3.7%. So the Fed has got an awful lot of work to do this week with the dot plot, the inflation, and the growth expectations. That could be one way that they regain some of the narrative. 10-year auction today, so we'll see how that goes. Continue to expect bull steepening on this curve. We'll talk to Ven Ram in just a moment. There's your dollar yen, 146.12. We just had Jane Foley. She said, look, you all got far too exuberant on those utterances from Ueda last week. So again, all the talk of 140, 135 may well be delayed. It may be just a better opportunity for you to re-enter and short the dollar there. Bitcoin was down 7.5% at one juncture this morning, down 3.25%. How much pro risk do you want to take going into the FOMC and what the Fed has got to say in terms of guidance. 60 hours will redefine for 60% of the global central bank's narrative and perhaps a new format of forward guidance. Danny, good morning.
Good morning, Manus. Yeah, I wrote down all the central bank decisions we have this week because there's no way I could have remembered this. It's Pakistan, Brazil, ECB, Mexico, Norway, Peru, Philippines, Switzerland, UK, and Ukraine. I can't even read it. It's so many. But of course, the fascinating thing is, and you kind of implicitly said this, basically the one major central bank that isn't going at it is Japan. That's next week. And yet this is the one that we're focusing on this morning. You do have a reversal of that spike yesterday. And it was interesting to hear Jane Foley, who said, look, all UETA said was that it's going to be more difficult for policy at the end of the year. That's by no means endorsing getting out of negative rates. Instead, Japan needs to wait for sustainable inflation above target, and then they can hike. There is no rush for them, Manus. They're going to go steady and slowly.
Yeah, and then, of course, Bloomberg Economics has said core inflation will be 3% for the close of this year. It slows to 1.8% going into next year, and then just 0.9% in 2025. So to squander all of the NIRP and all of the YCC narrative for the past number of years would be folly, and that's the point that Jane Foley at Rabobank made for us this morning. So let's just reset for a moment to politics, Danny, because Ukraine's Vladimir Zelensky is headed here to the United States, to Washington, for talks with President Joe Biden. Ukraine is facing a second winter of war amid uncertainty over continuing aid from the country and from Western allies. Bobby Ghosh is our regular Bloomberg columnist on a Monday morning. So, Bobby, here we are. You know, Zelensky and Biden again, but there is a clock that's ticking, which is, you know, Washington's ability to deliver aid for Israel and Ukraine. How dissipated is the appetite to give additional Ukraine aid? How much of a battle does Zelensky have on his hands?
He has a huge battle. He's running short of ammunition. He's running at a sort of short of supplies of cash. The Europeans are giving him some, but there's resistance there too. In the U.S., the Biden administration is essentially being held hostage by the Republicans over talks about the border in the United States, and the Republicans, are basically pegging their support for Ukraine to a far more divisive topic, which is border. And so it's a very difficult week for Biden.
Biden himself has said that he's prepared to make negotiation on, and sizable negotiation.
Yeah, so this will be a week where we hopefully get to see some meat on the bones of that statement. He said that he's willing to make some concessions. What exactly is he prepared to give? And will that be enough for the Republicans? If history is anything to go by, they will always want to ask for more. The question is, will they untie the purse strings for Ukraine in the meantime, enough to give Ukraine something to survive through the winter? At this very moment, while this is going on in Washington and while Ukraine is low on supplies, Russia is turning up the dial. Russia has had a difficult summer, but its supplies seem to have now gotten to a point where its attacks on Ukrainian territory with drones and missiles is ratcheting up. So it's a really, really sensitive moment that Ukraine comes to, beg your pardon, that Zelensky comes to Washington. He desperately needs much more American support.
And not to mention the sensitivity of Viktor Orban, Hungary's president, also heading to Washington, getting an audience with Republicans. What do you make of that, Bobby?
Well, yes, Orban is here. He is already holding up European Union supplies to Ukraine because his country is a member of the European Union. But he's here to try and persuade Republicans to keep pushing back against the Biden administration to restrict the supply of American aid. Orban is very close to Vladimir Putin. He's a right-wing populist. He has a lot of admirers within the Republican Party, and he will be essentially caucusing with the Republicans. I mean, this is really quite an astonishing idea that somebody from Eastern Europe, Eastern European leaders, someone who has taken strong anti-American positions in the past, someone who's very close to Vladimir Putin, clearly an enemy of the United States, is coming to Washington and is going to caucus with members of the Republican Party against American interests. The fact that he can do this at this moment, it tells us something about how broken American politics is. But to Zelensky and Ukraine's point of view, that's why it's all the more important for Zelensky to be here for that photo op with Biden to try and fight back against that kind of pressure.
And certainly on the Sunday programming that I watched yesterday, it was, you know, this is a moment where Putin, if he feels emboldened, he may well, you know, take more of Ukraine, and then NATO has a much bigger issue if the US is seen to have not done the right thing.
Yeah.
Look, let's just talk briefly. The one thing that I did notice was not covered very much in the Sunday shows was the United States, you know, vetoing against the demand for a ceasefire. Britain abstained.
Yeah.
The United States of America vetoed against a ceasefire. This was put on the table by the Emiratis.
Yes.
Supported by 100 nations. What does that say?
Well, it's consistent with Biden's full embrace of Israel and his sort of support for Israel against Hamas. But it's in the International Court of Public Opinion, if you like,
yes.
This cements the idea that this is Biden's war as much as it is Bibi Netanyahu's war. And there is a price to pay in terms of international opinion. Biden is being consistent to his own word. He said that the United States would back Israel to the hilt. On the side, in the background, his officials have been trying to get Israel to go easier on the Palestinians, to make sure that this second phase of the offensive is not as devastating, does not take as great a human toll, and particularly a toll on Palestinian civilians, as the first phase did. But when push comes to shove, when it comes to things like resolutions in the United States, Biden's demonstrating that he's fully behind Israel. That only, as I said, that only confirms in the minds of a lot of people around the world, certainly in the Arab world, but elsewhere, that this is Biden's war as much as it is Israel's.
Bobby, I'm afraid we're going to have to leave it there. Thank you so much for joining us on this Monday morning. That's Bobby Ghosh of Bloomberg Opinion. Now, elsewhere, the uproar over the handling of anti-Semitism at some of the U.S.'s most elite universities is continuing to grow. Now, Harvard's president, Claudine Gay, is facing mounting pressures to resign. Former Treasury Secretary and President Emeritus at Harvard, Larry Summers, discussed the tensions around anti-Semitism at universities on Bloomberg's Wall Street Week with David Weston.
It's very important for us to remember that if universities start being run by politicians or by small groups of large donors, that's going to be a very problematic thing over time for the American university system, which is a huge source of strength for our country. That said, David, we have to recognize that there's been a double standard in how incidents of racism have been regarded in the past, incidents of what people call microaggressions, incidents of things that make people feel hurt or sensitive have been regarded in the past, and the way things that are abhorrent to the sensibilities of so many of us have been regarded in the last several months. And that double standard, which in different ways has been present on many campuses, creates an extremely difficult situation.
Larry Summers is Harvard University professor and a paid contributor to Bloomberg Television. As we set up Monday morning, it is a big week on inflation. You've got central banks, the Fed, the ECB, and the Bank of England all meeting. Spurs just break their overall running trend, 6 weeks of gains, longest winning streak since November 2019. Yet, doesn't stop Citi from coming in full bull. They reckon the S&P 500 will make a new record next year because of consistent sector-level earnings. They're looking for 11% rise from here into next year. Dollar is up a tick or two as the short end of the curve re-rates higher. Likewise, 10-year paper trading 425. We have a 10-year bond auction today. Let's see what the appetite is for that. Any indigestion post the weekend? Good morning from New York and London.
Trends in global leadership are on Bloomberg.
What we've just delivered are significant tax cuts. For business, we will be the only major G7 economy, certainly, and even broader than that, where you get a total write-off against your taxes for capital investment. And it comes on top of the fact that our corporation tax rate here is lower than any other G7 economy. That's an incredibly generous regime to attract business investment.
Nobody covers the top global leaders like Bloomberg Television and Radio. Context changes everything.
The reception, the acceptance of Puro Sangue has been extraordinarily high. We had to stop the order for a while because we had to understand how to manage the supply chain. So there is a strong traction of Puro Sangue all over the world.
How much do you worry about increasing production and therefore becoming, I guess, less high-end luxury?
We are making 13,000, 14,000 cars per year. We will not grow a lot in the future because we want to grow more for value, not for volume. And maybe one number, you know how many cars Ferrari did we put on the road since the beginning, since the first one? 250, 260,000. So a 250,000 cars in a market where there are million and million of cars every year.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
It's Bloomberg Brief. Danny Berger in London, Manus Cranny in New York. Manus, it is a huge week. In 60 hours, 60% of the world's central banks will give rate decisions. Here are the majors. Wednesday, you get the Fed. Thursday, ECB, and also the Bank of England. Joining us to give us the breakdown on all the big moves is Bloomberg MLive's Ben Ram. Ben, if you look at what we're potentially going to get out of these majors, basically everyone is expecting them to hold. But I got to wonder, are they going to push back? Is the Fed going to push back on market pricings of a cut?
Morning, Danny. Absolutely. I do think that they will push back on the notion of rate cut sooner rather than later, simply because you saw the data from last week, the non-farm payrolls data that showed the jobless rate going down. That's not the direction they wanted going in. They wanted going higher to get the labor market into balance. There is no semblance that that is happening just yet. And in the meanwhile, we've got the disinflationary narrative going well. So that is just one side of the equation. The other side of the equation just doesn't seem to be following the pattern that the Fed wants it to. So I do think that the Fed will come out next week and say, you know what, it's going to take longer to get the labor market back into balance. And therefore, there is not going to be any rate cuts soon. And that's the message that investors seem to be glossing over.
Ben, I loved your piece this morning on the MLive blog in terms of the shape of the curve and where we're going. There's going to be a continued steepening. It will endure. So great piece. It was one of the first things I sent to myself in the taxi on the way in. What about the ECB? I mean, bond yields have dropped by 40 basis points. Lagarde isn't going to stand at that podium and say, yeah, we're ready to cut rates. So I like what State Street say. There's no way the ECB is going to give you a readout that could exceed market expectations. So the risk is that she underwhelms. How does that play out then? There's yields at 225 in Germany.
Absolutely, Manus, you're right, and thank you for the kind words earlier. So I do think that, look, German two-year bond yields are around 360 now, and I think they will stay put around there, 360 to 375, because the ECB, while they've reached the terminal rate, they're not going to cut rates anytime soon, as you mentioned, because core inflation is holding above 4%. So it would be very unlikely for the ECB to come out and say, you know what, we want to pander to the markets and we will get that loosening done. We know that the euro area economy is muddling through, but that is already a known quantity, a known vector, and the ECB is not going to say, we are going to cut rates sooner than the markets want. That's not going to happen.
Well, and then you have the BOE the same day, then, who does have an inflation problem on its hands, that wage pressures maybe are still getting to them. Jane Foley of Rabobank was just with us talking about the potential for sterling strength with some major pushback from the BOE. Does the BOE stand alone here in that regard of actually needing tighter policy throughout 2024?
I think that may very well be the case, Danny, because, you know, you've got inflation, core inflation around 7%, services inflation around 6%. Excuse me, services inflation around 6%. Those are largely incompatible with inflation of 2%, inflation target of 2%. So the BOE doesn't really have a choice. They're going to come out and say, you know, we are not even discussing rate cuts. It's not even on our bailiwick at the moment. So I do think that there will be some sterling strength on the back of that, yes.
Okay. Ben, thank you very much. That is Ben Ran on the M Live team there at Hop on the blog every day. With 2024 coming to an end, Bloomberg Economics is out with a new report on what they expect for next year. Jamie Rush is the chief European economist for Bloomberg Economics, and the cup is not half full. It's one could say perhaps a little bit half empty. How's 2024 going to look in terms of global growth? We're going to get the rates narrative this week, but you're not that optimistic for 2024.
No, I think what we're expecting is that certainly advanced economies are going to see slower growth in 2024 than they did in 2023. We've got 0.9% relative to 1.5% this year. So we are going to feel that things are ebbing, and that is below the trend growth rate of the economy. But one thing I would say, though, is if someone had said to me a year or so ago, will the global economy keep growing as interest rates move where they've moved to, I think we'd be relatively surprised. So I think there is actually a positive story out of this, is that the impact of rate hikes to date have not been as painful as you might believe if you looked at central bank models or anything else out there.
Yeah, I mean, it's caught virtually everybody off guard. If we're a little bit maybe more dour on growth, again, not devastating, but more dour, what about inflation? Are we more positive on that being reined in?
Yeah, I mean, we do expect inflation to head down. Again, in advanced economies, that's heading towards like maybe 2.6%. That's kind of our average for 2024, down from quite a bit higher than that, 4.8 in 23, and a kind of mind-blowing in excess of 7% the year before. Now, the thing is that, as we all know, is that it's going to be very difficult to get that last chunk down, and until we see a loosening in the labour market, wage growth starting to fade, I think it's going to be very hard to see inflation falling below that. And for now, at least, that's not in train. So I think we're all going to be watching the labour market very closely, and that really is going to be what's going to unlock that key to lower interest rates.
Okay, Jamie, thank you very much. That is Jamie Rush of Bloomberg Economics. And a check on your bond market as we head into this big week. You are looking at yields moving higher in the U.S. We're only 3 basis points higher. Germany comes down. Maybe those fears of recession weighing on the bond market. And the ECB standing alone in actually having to maybe disappoint this market and not being as hawkish than 10-year yields in the UK, basically unchanged. But Manus, in the meantime, some breaking lines on Tesla. The Tesla appeals court decision on the Swedish Postal Service. Basically, Manus, the Postal Service had been joining a sympathy strike and not mailing people license plates for Tesla. So if you bought a new Tesla, you essentially couldn't drive it because you couldn't get a license plate.
Exactly. And if you look at the fallout, you've got the Norwegian Sovereign Wealth Fund talking about respect of decisions. You've got the Danish, there's a whole sort of Nordic fallout in terms of this story from sovereign wealth funds around the world in their position. There's Tesla 242.18 as they go into battle over the decision by the Swedish Postal Service to go out in sympathy with their colleagues at Tesla over the refusal to sign a collective agreement covering the basic rights such as pay levels and working hours. This is Bloomberg.
thought maybe I should go do something else. I can't do anything better than I'm already doing. I already turned this company around. I've made a lot of money for the investors, the shareholders, and yourself. Are you happy doing this? You're going to do this for the foreseeable future?
I'm going to do it for the foreseeable future. I love what I do, and the reality is we've accomplished a lot. As you described, we've made Blackstone a lot of money. We made our shareholders a lot of money. More importantly, we've grown the business, and we've been a huge engine of opportunity. If you think about all the jobs we've created around the world, all the communities we've made better places, all the ownership groups who we've helped grow their business, and having built a world-class culture, the opportunities we've created for upward mobility for people. And this business, I would still say, is like a coiled spring coming out of COVID particularly. So I feel like we just have more to do. My job's far from done.
From the world of politics to the world of business, every weekday at 5 p.m. Eastern Time, hosts Anne-Marie Hordern and Joe Matthew alongside Kaylee Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, every weekday at 5 p.m. Eastern Time, only on Bloomberg. Context changes everything.
You're watching Bloomberg Brief. Danny Berger in London, Manish Cranny in New York. Let's get you set up for your trading week. Here's a look at what's ahead. It's a busy one. We're going to have a host of U.S. data, CPI Tuesday, PPI on Wednesday, retail sales and jobless claims on Thursday, then PMI on Friday. And as we're just talking about, a massive week for central banks. Fed kicks things off on Wednesday, followed by the BOE and ECB on Thursday. And we're also going to get decisions from the Swiss National Bank and Norway's Norges Bank on Thursday. Certainly not a quiet December week, Manus.
No, it's not. And certainly in terms of deals, I mean, we're coming into the close and there's a bit of Christmas cheer around the corner at Bloomingdale's and Macy's. Well, let's see how that plays out. Macy's said to have had a near $6 billion offer from the investor group. So let's see if that goes through. 21% premium from the investor group. The close of business on Friday. The stock is up this morning, as you can see, up 18%. It's given a little bit back, Danny. And then, of course, Sigma also in the news.
Yeah, they had been long talking with Humana to buy them. They've called off those talks, Manus. Instead, they're planning a $10 billion buyback, hence the 13% rally pre-market.
And never to be left on the shelf, Oracle, what will their cloud business do? You know, that is one thing. There's a line in the preview here. We're going to get their numbers a little bit later on after the bell. Despite growing interest in Oracle's cloud business, the company faces execution risk associated with the build-out of the data centers. Danny, Monday morning, deals aplenty, dollar yen's on the move. What's not to love?
A beautiful pre-Christmas Monday. We love it.
What do you consider to be the biggest challenge?
Infrastructure that supports trade is the biggest challenge. Our senior brother, President Adesina of the AFDB, estimates the annual deficit, infrastructure deficit in Africa to be over $100 billion. But that over $100 billion is actually also an opportunity for investment. So it is a massive, significant challenge that we are confronting. And my fear is that we may succeed in establishing a very effective legal construct and a very effective legal foundation for trade liberalization and investment liberalization in Africa. But all of that will come to naught if the infrastructure deficit is not addressed, because you will need the goods to move somehow, and you will need to have good trade corridor connectivity, ports, trade corridors that connect countries that are landlocked to the ports.
Labor markets have been strong. It's going to be an interesting story when that reverses in the coming year.
You're really not seeing the level of restrictiveness show up yet in the labor markets.
We are still looking for a soft landing, but we do think that recession risks are probably a little bit higher now.
We should all be very humble about recessions. They never happen, right when you expect it.
This says we're not in recession right now, but it's not necessarily an all-clear signal for next year either.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Good morning, everyone. Jonathan Farrow, Lisa Abramowitz, and Tom Keene on radio, on television. What a week it will be off of the jobs report, the continued equity celebration we saw last week. It is deep in economic data and deep on shifting calls into 2024. Lisa, where are you going to be? And I'm going to let you pick the audible. What interests you?
This week being a massive week, the last massive week ahead of a really quiet period of time and a real pivotal moment where everyone's talking about potential rate cuts. People are talking about disinflation that's immaculate without that slowdown, and people trying to figure out exactly what the threshold is for central banks to cut rates.
John Farrow on assignment here. Bramo back from Pine Tree, Vermont. It was a hell of a weekend. Tell us about the American economy. You're dreaming of a white Christmas. Tell me about Pine Tree, Vermont, and what you saw. Was it packed? Was it buoyant? Was it booming?
It was not packed enough to make it a pleasant experience. I'll just say this. You are seeing still people spending. You are still seeing restaurants packed. I will say that there was snow for a hot second, and then it was rained away, and that's what we're experiencing right now. So there is that. But we were also discussing heatedly inflation, and we were heatedly discussing the fact that oil prices, that gas prices were below $3 a gallon in some places as we were going down Jersey, which gives you a sense of where we are and some of the disinflation that's very tangible to people out there.
Let's get out of the 3 zip codes we live in, and what to me is so important here is retail sales on Thursday, wrapped around the ECB and the Bank of England, is maybe the data point of the week in terms of figuring out the real GDP.
There's so many data points of the week, right? It starts with CPI tomorrow. We get a sense of just how much inflation has ticked up. And I thought that this was really interesting from Deutsche Bank putting out this morning, that if it comes in as expected, the trailing 3-month and 6-month averages for core CPI will have fallen to the lowest, below 3% for the first time since March 2021.
We're going to get that in a brief here to get you set up for the week as well. On the data front, it's simple. Futures at -5, Dow futures -25. VIX is, it's up a little bit off the Nirvana Friday, 13.09. The real yield, 2.02%. I haven't looked at the 30-year mortgage yet. Oil, $70 a barrel. Brent crude, 75 a barrel. A fractional dollar strength. I'm struggling here. There's not that much to chit-chat. You mentioned Swiss National Bank. I mean, they're being ignored here. With strong Swissy, it's actually a, it's an inside baseball discussion, but there it is.
Are they being ignored or just overshadowed? Let's give you a sense. We'll go by the play-by-play throughout the week, since this really is going to be a momentous week. The economic data, just to lay it out for you, tomorrow, I think probably the biggest data point of the week. CPI. Wednesday, we're going to get PPI, getting a sense of those factory prices that are coming in. And then retail sales on Thursday. Again, the idea that if you have a trailing 3-month or 6-month average in the core CPI, you're looking at some of the lowest levels going back to 2021. This is significant.
It was in the literature this weekend, and what's important here, folks, is there's month over month, year over year, and then all the adults are using whatever summed average or cumulative study they can, and I guess they all point to disinflation.
They do for now, and that's sort of the key question, especially if the year-over-year comps get more difficult next year. We get a sense of the reaction function. FOMC meeting on Wednesday. We will be having the Fed decides later in the afternoon. ECB, SNB, Swiss National Bank, and the Bank of England all coming out on Thursday. This comes after what we heard from the Bank of Japan overnight. Bloomberg reporting that they're kind of pushing back against shifting away from their negative rate policies. Why do you grow?
Euro yen 157. It's not back to 160. It's come back a little bit. It's weaker yen in the last 72 hours, I'd say. So it's going to be ugly. When it goes, it's going to be ugly.
Maybe. And the question is just how much could they prolong? How long
there's
it'll be?
auctions today.
There's so many auctions.
I see it on the teleprompter.
It's not just today. It's there's $50 billion of 3-year notes today coming at 11:30 a.m. $37 billion of 10-year Treasury auctions. That would come at 1 p.m. today. $21 billion of 30-year bonds coming tomorrow. To me, this is fascinating, especially because last month's 30-year auction roiled markets. This matters. Tom, there was an entire article in the Wall Street Journal on the front page basically saying, auctions matter. Hey, Tom, this is actually one of the biggest points.
Bring it up on radio. Bramo's going to give you your first read for the day, please.
Is this sense that we are going to potentially get roiled by markets? All right, you want to take a look at what this is?
There we go.
All right, why Treasury auctions have Wall Street on edge. In other words, why does Tom need to care about Treasury auctions?
Eric Wallerstein, I hate you.
Whether the market can absorb the rolling waves of debt without disruption is the biggest question on Wall Street. The last 30-year auction was so poorly received that it rattled other parts of the markets. And I will just say, Tom, we have seen almost record amounts of issuance so far, and we have almost a month left.
Okay, there we go. Last night, a bombshell. We're going to begin the week, and this is really, first I got to get my bow tie straight. There we go. This is really important, and this is about what we've talked about through this pandemic, the courage to be in the markets. Last night, a bombshell from Edward Yardeni, and what he did is not so much pick a level of the equity markets and your courage to be in it, but he took his timeline out, his x-axis out. Dr. Yardeni, rather than raise our year-end target, 2023, we are raising our expectations of what we can do to end of 24 and beyond. We are now raising our year-end 2025 to 6,000, assuming $300 SPX earnings. That's a stunning statistic. Throws on a forward at 20, and even Sarah Ketterer can do the math. She is Chief Executive Officer, Fundamental Portfolio Manager at SPX 6000 Causeway Capital Management. Do you have the optimism that Dr. Yardeni shocks us with this morning?
That's a tough one to call, because right now, this year's been a lot of multiple re-rating upward, which is very curious in the U.S. market, given that interest rates have gone up. I mean, it seems so odd, because it was just the opposite. As rates were falling, we had multiple re-rating upward. So investors are clearly very interested in getting access to U.S. earnings. But this may be very tough for S&P 500 earnings to grow at that level.
To get a 300 on it is a stunning statistic.
The Fed has been so active, as we all know. How in the world do those earnings materialize with such economic headwinds ahead?
He calls it the roaring 2020s. And the bottom line is you need real GDP and GDP plus inflation on top of it. You got to pop a 5% nominal to get to $300 earnings, right?
And will we? That's the question. Look, you can't have it both ways. The Fed is engineering an economic slowdown. An economic slowdown impacts earnings. And so then that takes care of inflation, but that also creates some real resistance to to earnings growth.
So you're basically pushing back against this Goldilocks, immaculate disinflation.
Yeah,
and
because
going to cut rates before anything
I
matters.
speak for Causeway and our whole team. We're value managers, and across all of our strategies, we manage about $43 billion, mostly value-oriented. And if you go in optimistic and you're wrong, that's worse than being very conservative in your estimates and then being pleasantly surprised.
What does value mean right now?
It means not overpaying and being very disciplined about price entry point and ensuring there's lots of room in case you've miscalculated so that the stock can still perform.
You are out of Los Angeles. It is the land of John Lovelace, Robert Kirby, and Capital Guardian Trust. And Mr. Kirby spoke to the nation in 1987, and he said, look, all you want to do is make the Standard & Poor's 500 plus 2%. That didn't happen this year. The Magnificent Seven up some 28%, I'm going to say right now, versus 18, 19%. How do you, as a value manager, adapt to this oddity, this non-dispersion?
Well, as long as investors care about diversification, there'll be room for value, there'll be room for non-U.S. investing to complement the craze in the U.S. And it's justified because the bulk of some of the most extraordinary technological innovations coming out of the U.S. and U.S. listed companies. We don't have in this country the same type of anti-monopoly obsession that, for example, Europe does. So we can have hyperscalers, we can have huge platform companies. But the question is, can they continue to perform as well as they have this year? And it seems unlikely they had to have consecutive years of such strong performance out of such a narrow part of the market.
What's the most important data point or event this week?
What the Fed does clearly is critical, but I think the Fed's risk is asymmetric in that the Fed needs to ensure that inflation is stamped out and will not return, which means caution.
So in other words, you think that the Fed is going to kill a rally in some capacity, and that as time goes on, that'll become more clear, and they're willing to do so, that their bar to cut rates is a lot higher than what certain people are expecting. What do you have to hear from Fed Chair Powell to confirm that, given the fact that he hasn't pushed back as much as some people were expecting about 10 days ago?
Well, he's attempting to engineer the Goldilocks soft landing scenario. And I don't blame him. But financial conditions have loosened lately. In fact, quantitative tightening, this reduction in Fed balance sheet that we were expecting to see this year in March, went the other direction, albeit briefly, just in order to put a floor under the banking system.
Yeah, I looked, Sarah, first of all, do you have Dodgers season tickets? I'm asking for a friend.
No Dodger season tickets, but maybe I'll change my mind now.
Maybe it's for $700 million. Why? I've got to ask you, we work with Paul Sweeney on Bloomberg Radio. You're living it in Los Angeles, which is the implosion of the media business led by the mother of all value blue chips, Disney. It's really not going well, to say the least. Not so much your prediction on what media will do, but as a value investor, what do you do when a Disney blows up?
Buy more. Disney and Netflix will dominate streaming. Netflix already does. Disney's getting to the point where their cash flow is beginning to turn up. Disney's going to be a fantastic story, in our view, next year. And then Bob Iger will be able to retire.
Sarah, thank you so much. Sarah Ketterer with us this morning. Causeway Capital Management. Good to have her start us off on a Monday. Lisa, I look at the blur here and the linkage into the Fed meetings. We've got to remember last week we were talking about ECB acting before the Fed, and I still can't get my arms around that. Is a less buoyant, less GDP-like economy. I just don't see where they've got the degrees of freedom to cut rates first.
Was the jobs market report that we got on Friday sort of consistent with any kind of rate cut?
It's a really good question. You go to it, folks. This is over the weekend. I'm sure you saw this, Lisa, when you were by the campfire there.
Singing Kumbaya.
Right. Well, I was probably singing White Christmas and the other Danny Kaye specials. But the answer, you do look like Rosemary Clooney now that I think about it. But the bottom line is they adjusted over the weekend. They went from a pretty good number, and then you take out the strike, and you take out this, maybe you take out 20,000 people out at Macy's. We're going to talk about that later. I'm not sure it was that good a number. It was good, but
all right,
was it that good?
Okay, it wasn't that good, but it was perfect disinflation. And this is sort of what a lot of people have been arguing. So Mike Wilson talk about how people are underestimating how much weakness needs to come along with the disinflation. We've heard that from others as well. And yet here's what we have seen, which is inflation coming down. Is it because of the Fed policies where they're at, or is it simply because supply side issues got resolved and suddenly prices are coming in significantly as the market kind of increases its productivity? This is the key question.
Are auctions the same at these new lower yields than they were in the sweat of higher yields priced down?
You know, this is the irony. They actually go better when people have a sense that they're stable, right? And that's what we've seen, is that when yields are actually stable for a period of time, people know what they might be getting. But here's the question, okay? We got 30-year auctions about a month ago, last month.
Didn't work out well.
It was really problematic. Do we get the same kind of thing? Because we haven't resolved some of the longer-term issues. The budgetary issues are not going to get solved. This is going to be the last functioning week in Washington before Congress goes on recess. Unclear whether functioning is really being used just simply as a generous term, or whether we actually get some kind of action.
We're going to have to see. Let me do a data check here to set up your Monday morning into this week. The VIX 13.09, -5 on the SPX. Futures right now, 2-year yield 4.74%, 10-year yield 4.25%. Really hasn't pulled back all that much. 2-cent spread, -49 basis points. And again, I stay focused on the real yield, 2.02% as well.
Tom, did you decorate your tree over the weekend?
Did not decorate a tree. It's on the to-do list.
Which one?
I think it's still alive. Maybe we are too.
London, in Sydney,
from Washington,
in Tokyo.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening.
Here's what I'm watching.
You do not want to miss this story.
Is there the kind of upside?
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. How has that shaped your strategy for the bank? Is this a new normal? Is this like a catalyst? Do you think we're in a new phase for dividend policy overall? That's a great question. I'm Francine Lacqua, and this is The Pulse, every weekday at 9 a.m. only on Bloomberg.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.
Folks, all this project stands in stark contrast to my predecessor. He always talked about infrastructure week. 4 years of infrastructure week, but it failed. He failed. On my watch, instead of infrastructure week, America's having infrastructure decade.
On the road, raising money, getting out in front of a presidential election. Mr. Biden speaking Friday in Las Vegas, going after the former president. The latest Wall Street Journal poll finds Mr. Biden trailing Mr. Trump in a hypothetical rematch. Lisa Brownwitz and Tom King. Mr. Farrell, much needed assignment today. Is he skiing? I
want to go on some of these assignments to talk about because they sound kind of nice. That's all I can say.
Yeah, we'll have to see.
Otherwise known as vacation.
Well, we're beginning a busy week, a huge economic week, and I really got to say, equity markets in shock over what we've seen week after week, day after day. And of course, we're really touching upon the Ed Yardeni note, looking out to the beginning of 2026, year-end 2025, S&P 500, 5,800, dare I say, 6,000. Lisa, that's a lonely call. I mean, there's others that are bullish, but they don't have the courage to take it out another year.
I think that that's the right point, which is, in other words, given all the uncertainty, how do you extrapolate further to that? And that's really what I feel like when we talk about some of the political backdrop. You're talking about the Wall Street Journal poll that talked about the former President Trump beating President Biden in a matchup at a wider margin. A lot of the issues, his not participating in the debate hasn't mattered. His legal issues haven't mattered, even though they continue this week in New York. So this is the question. Is he the presumptive nominee? And not just that, is he the presumptive potential president in a way that people really haven't factored in?
In December and on to a new January of Iowa caucuses and New Hampshire primaries. Greg Valliere briefs this morning, Chief U.S. Policy Strategist at AGF. Greg, Lisa wants to talk about the various and sundry wars we're in. I need to talk to you about the war that's coming in the presidential election. Is it that Trump's ahead, or is it that Biden's behind?
I think it's more the latter than anything else. Just listening to the sound bites over the weekend, Tom, were just cringe-inducing, really, from both Biden and Trump. If we're in for another 11 months of this, this is cruel and unusual punishment for the American voter who still thinks there's a chance for somebody else.
There's somebody else out there, but it's not going to be decided, I would believe, at the Iowa caucus or the New Hampshire primary as well. Where are we in February after those January political events?
Well, Trump will win, obviously, in Iowa, but maybe not by quite as much as people had expected. I think that will be the presumptive nominee by the middle of the spring. That's not a real courageous call on my part. But with the Democrats, I still think there could be a surprise. Maybe this guy from Minnesota, this House member, he's way behind, but he's different. He's new. Even Robert Kennedy, who's pretty exotic in his views, has attracted some attention. I sense a lot of Democrats who, not just David Axelrod, who are desperately looking for someone else.
Greg, your language is really colorful this morning. Cruel and unusual punishment for the American people if this has to continue. And the exotic views of Representative Kennedy, I am wondering how much you think the likelihood of President Biden stepping aside for another candidate is tied into some of the military conflicts that the U.S. is currently supporting or involved with.
Well, there's two big stories, Lisa, that you allude to. Number one is the trouble that Trump will have with his son. This is going to go on, and it's an embarrassment. It's a distraction. It's a plus for Trump. But the other big story is who lost Ukraine. I think that could be a devastating story for Washington in general. If we can't get money for Ukraine, and it looks unlikely this week, maybe they'll get a pittance, maybe they'll get a haircut, but I don't see a huge chunk of money coming for Ukraine, and Vladimir Putin has to be very happy.
Volodymyr Zelensky is coming to Washington, D.C. this week, I believe on Wednesday, to talk directly with Congress members, including House Speaker Johnson, to try to plead his case. Over the weekend, there was a lot of discussion about how essentially this comes down to funding, and if Ukraine doesn't get funded, they're going to lose, and that was what a lot of people were talking about, especially because Russia is putting about 40% of its budget into the military. Do you agree with that assessment, that this is sort of the turning point where if Ukraine doesn't get aid, it kind of ends?
I guess I'd say it all depends on the definition of lose. I don't think Ukraine is going to lose the war anytime soon, but they're clearly on the defensive. They're backpedaling. They've not had a good winter. They lack supplies. So I would say that the momentum right now is with Russia. And if that's true, what does Vladimir Putin think about Estonia, Lithuania, Latvia? Does he think about other Central European countries that might be next?
Greg, the news over the weekend on Gaza was just absolutely grim. There's no other way to put it. It's a point where it's almost subsumed within the media because of just the weight of the grimness as well. What is the action the administration can do this week?
I don't see a lot. I don't see much that we can do. We could send more aid, but I think if it's tied to Ukraine, that's not going to happen until after the new year begins. No, I do think, though, that in terms of the Arab Street and the world in general, the Israelis maybe only have a few weeks left before they totally lose support. I think the window is starting to close on the Israelis. They've got to wrap this up pretty quickly.
Lisa, jump in here, please.
Well, I'm just curious. There was so much discussion over the weekend about the university presidents, the potential resignation of Harvard's president after what we saw from UPenn. I'm just curious. We're hearing that a lot of conservatives are saying, "We told you so," and that universities have been constraining freedom of speech for a long time, and that this is just one example. How much do you actually see Democrats joining with that versus sort of voyeuristic arguments being made around this?
And good word, voyeuristic. I don't see anything that is that's going to change the political landscape quickly, but it is an embarrassment for the Ivy League, and I think that will persist for a while. One other thing really quickly, the abortion fight in Texas has long-term implications. I think that more and more people will be looking at this saying that this is not right.
Greg, thank you so much. Greg Valliere with a Monday eclectic brief. There are many, many different topics here, including what we see in Ukraine. Another equity call is in off of Yardeni's view to end of 2025. John Stolfus, Lisa, keeps it a little short. He's been a bull. He was a bit of a pinata 18 months ago, but he's been right. And what's important here, folks, is the construction of this out to, what is it, 5,200 short term. You know, it's like a normal call, not what Yardeni's doing. 9% earnings growth next year. And he slaps a 21.7 price to earnings ratio on top of that. And that's how you get to the P, which is, I think, 5,200. That's a more conventional call than what Yardeni did.
You know what's interesting to me? We're getting so many different calls, and they all are completely underpinned with different reasons. You either have good news is good news, which we heard from Stuart Kaiser's City team. Well, this is basically, they came out and they said, good news is good news. Stuart Kaiser, I could hear him screaming into his paper as he typed that. But then there's this question of, is it entirely because the Fed's going to cut rates? And this just now from Tony Dwyer coming out and saying the zombie killer and talking about we have a zombie economy from rapidly rising inflation, Fed rates, and quantitative tightening. This is your word, right? The zombie roll-up. He said that basically the only cure is rate cuts and a significantly to the downside.
And we haven't even touched on it this morning yet. The zombie roll-up is when you can't do a merger because there's a lot of regulatory talk.
So
and
you do
Cigna
buyback instead.
And, you know, they want to be the next United Health, Cigna and Humana. So, well, let's buy back $10 gajillion of stock. I mean, it's sort of a zombie December almost when you see things like that.
Was that really because of regulatory issues or just that they couldn't establish a price?
Well said.
Especially considering the fact that both of their share prices went down, and there was a big question around that. So to me, what I find interesting is actually the question you've been asking, which is use of cash, right? How much are these companies going to use cash and deploy it for something that might be sort of synchronous in some capacity, some sort of tie-up versus just buying back shares because there's nothing better to do.
I think use of cash is underrated right now because everybody's looking at 5% and going, nobody cares. And the answer is, I think in the first half of next year, it could surprise. Now, you know, I've been a little depressed, folks, because at our world headquarters here right across the street from Bloomingdale's, I did audition gig, you know, the gig economy of Santa Claus.
Oh, yeah? And you didn't get it?
But I didn't get it. They turned me down. But I'm thinking Macy's. I mean, you know, with the Macy's takeout, you know, maybe I ought to run down to Herald Square today.
I can just picture this. Some kid sits in your lap. Like, ho, ho, ho. What do you want for Christmas?
I was like in the Christmas Story where they've got the slides. See ya, kid.
You'll be like, let me tell you about the microeconomies within that toy that you just asked for.
You know. Futures at -8. Good morning on radio and television.
think this will probably go down in history as one of, if not the largest financial crime ever.
I cannot imagine a scenario where $8 billion just disappears.
Bankman-Fried has pled not guilty to multiple fraud charges.
Sam was just too important in the crypto community.
When someone says, I'm going to give $1 billion in the next 2 years, like that catches everybody's attention.
As time went on, their ideas got like weirder and weirder.
I don't think he even had almost a conception at some points that it was wrong or right. I think he just had the mentality that he has to win.
This committee will not stop until we uncover the full truth behind the collapse of FTX.
So, Mark.
Are you in?
I'm in.
I'm in.
We're in.
Will this be the last of its kind? No. This is the nature of capitalism. Get over it.
Bloomberg surveillance on economics, finance, investment. We do international relations as well. Have to do that with what's going on in the world today. An exceptionally busy week. John Farrow on assignment. Lisa Bramowitz, Tom Keene, thank you for being with us on radio. On radio, there's this thing called CarPlay. Did you have CarPlay this weekend when you're gallivanting around?
We had other types of, play in the car.
CarPlay's a thing you put in your car. And I'm learning.
Thanks, Tom.
No, I'm learning about it. You press buttons, and I'm back with the Nash Rambler has the old little dials that you turn. There's no push buttons.
Wait. Pause.
Yeah.
CarPlay. It's a thing with buttons. You push it.
Yeah,
put
it's
it
Apple.
in your car.
Apple CarPlay. And it's like growing. It's like ginormous growing. I don't see it because in the Bentley I use Bluetooth. Okay, to go up to the driver.
All I can say is, okay, all right, let's talk about where markets are
on
right
radio
now.
and television. We're going to get under surveillance here. We do this with futures at -6. Lots of equity calls this morning. We'll get to that through the show.
Well, and really highlighting how we've gotten 6 straight weeks of S&P gains. And here's really the question. Is this just a function of yields going lower, or is there something more significant behind it, including better earnings? We get a sense of that. Under surveillance this morning, very much front and focus central banks this week. The Fed rate decision coming on Wednesday, followed by the Bank of England and the ECB on Thursday. All of that coming ahead of the Bank of Japan the following week, early next week, where officials see little need to scrap its negative interest rate, according to Bloomberg reporting. There had been speculation last week that the BOJ might move to end its negative rate policy as soon as this month. The Bank of Japan will be in focus next week. This week, Tom, I'm so interested to see how much Jay Powell pushes back against the sense that they're going to cut rates in response simply to inflation coming down rather than true economic weakness that a lot of people say is necessary to get inflation under control.
He hasn't written the script yet. He's got to wait to see what the economic data is, like everybody else. He doesn't get it like 2, 3, 4 days ahead of time. He gets it,
Well, he has some time,
Tuesday.
but it's kind of limited, and we've gotten a real easing of financial conditions. I mean, 6 straight weeks of S&P
Okay, but
gains.
cut to the chase. Can he cut rates this meeting? The answer is no.
Is that your litmus test
No,
of
I'm
what an
asking
interesting
you.
meeting? He's
I'm
not
just
going to cut
deciding
rates
whether
this
to
week.
show up for the Fed
Okay,
decides.
you
but,
should show up, but he's not going to cut rates. He's not going to do anything, but he might indicate some pause, and we get the statement of economic projections, the dot plot, and we get a sense of whether they revise that in any way. Let's move on. Shares of Macy's surging in pre-market trading.
She sat across the kitchen table.
With the retailer receiving a $5.8 billion buyout offer from an investor group, Arc House Management and Brigade Capital Management offering $21 a share for the department store operator. It comes as the company readies for a changing of the guard. Jeff Jeanette, the CEO, is retiring in February. He is going to be replaced by Bloomingdale's CEO, Tony Spring. Maybe you can talk to him about getting a job as Santa Claus. Why are you so keen on that?
It's Santa Land. You have to. It's so popular here in New York. You have to make a reservation. It's free. But you got to make, you don't line up like in the Christmas Story where they throw the kid down the slide. You have to make a reservation to see Santa.
To be the kid or to be the Santa?
No, they won't let me in.
Well, we'll just say this. With respect to the Macy's tie-up, what I find interesting is this question, can they do better as a private company? Is this a company that has been hampered by activist investors and short-term thinking, and are they going to be more successful private? You're seeing shares there rising by more than 20% at one point, more than 22%, but that's really a key question in my mind.
Yeah, it is, and what's interesting here is it's up and it's a success, but do you want to buy into an industry with a 10-year track record of retail? I don't have any opinion on this, but if I look at Nordstrom's, if I look at Macy's and the others, it's like, what does the last 10 years teach me? Is sort of where I am.
What they teach you is it's a different mechanism of buying things, right? And so there was one activist investor at Macy's who was talking about spinning off the e-commerce unit in particular because that had different kinds of values. I view a lot of department stores as basically closets where you go try on the stuff and then you order online what you want, but I digress.
I just did that. I bought a pair of shoes, and I did that. I went in the store, tried them on, and then I bought them online.
I mean, that's essentially, I think, what an increasing number of people are doing.
I bought a pair in 8 years, so yeah, it was good.
You know who has bought a pair in 8 years? Baseball star Shohei Ohtani. This, to me, was the big news in the younger Bramo household. Shattering the record for the richest contract in American sports, signing a 10-year, $700 million deal with the LA Dodgers. Ohtani, the reigning MVP, best known for his ability to both hit and pitch, comfortably topped the previous biggest American sports contract, the $450 million NFL star Patrick Mahomes is expected to receive from Kansas City Chiefs.
The biggest contract, and I saw a little bit of the game last night, is Mr. Kelsey on the Kansas City Chiefs. He got the biggest contract this year.
Do you think it's manufactured just for that?
What? Kelsey and
Taylor Swift, yeah.
I don't know. He made a good catch or whatever, and they showed her hugging some guy up in the booth. I mean, that's the NFL.
Talk about stealing his thunder, right?
Yeah, I mean, that's what we're going to see. This Ohtani thing's a huge deal, folks. No doubt game changer. Look to Bloomberg Business of Sports seriously. Michael Barr, Damian Sassower, and one S. Fu, and they'll have a lot on this. It's a real complete adjustment in what we see in the economics of sports and entertainment. Now on our week forward economics, and here we're really going to focus on your cumulative inflation. Sarah House joins, senior economist at Wells Fargo. Sarah, we got so much going on. I really want to focus here on CPI. A gallon of petrol, we're doing this for John Farrow, we miss him so much. A gallon of petrol is down 32% from the midsummer surge of a year ago. Isn't that disinflation?
Yeah, so that's the decline in gasoline has certainly been a huge tailwind to the disinflation story we've seen, where overall consumer CPI peaked at a little over 9% last summer, and we're looking for it to come down to 3% on a year-over-year basis when we get tomorrow's numbers, which would be the lowest since March 2021, essentially when we saw that broad reopening of the economy. But it's also not just the improvement in the energy prices that we've seen contributing to this disinflation. It's goods more broadly, and more recently, it's also been housing helping it. So it's beyond just energy.
Nice board. You see this, folks, on radio. Headline inflation year over year, 3.1%, distant from the agony of a year and a half ago. Sarah, help me here with what Mike McKee says, which is I should look at month over month, hyper month over month inflation dynamics versus this phrase that I'm using from Lyle Brainerd, cumulative inflation. Don't tell me Wells Fargo clients aren't agonizing over the cumulative inflation of the pandemic.
Well, I think it depends where you sit in the economy right now. So investors and policymakers, I think they are looking very much more at some of the short-term trends in inflation. So focusing on, not just what we're going to see in terms of headline CPI tomorrow and the month-over-month changes in the core, but what we're looking at on a 3-month annualized rate, where we expect core CPI to be little changed at around 3.5% on that 3-month annualized basis. But when you step back and you think about the cumulative inflation, I think that's what a lot of consumers are still feeling. So the fact that you've seen the price level rise close to 20% in just 4 years. So yes, we're seeing inflation slow, but consumers aren't really feeling that right now. And they're still seeing a high level of prices, which is contributing to some of the consumer fatigue that we're starting to see develop and we think will carry on through 2024.
And this could potentially create over time a sense that maybe inflation is plateauing with people getting some fatigue. But Sarah, you've been excellent about the last mile of getting inflation down. Do you think there truly is some fear that if the Fed slightly eases, cuts rates next year by 50 to even 75 basis points, that could potentially reignite inflation in a material way?
I'm less worried about a reacceleration, but thinking more about how long it takes to get all the way back to 2%. So I think we still have a lot of disinflationary forces in train. So I mentioned goods prices earlier. So we've seen supply chains improve rapidly, some of that consumer demand fading. And so I think there's more runway for goods to outright deflate over the coming year, especially in the auto sector. I think housing has a lot further to decelerate as well. So further disinflation in that sector. And I think even in services ex housing, given that you are seeing cooling in the labor market, that there's room for that to slow down as well. But do we see that slow enough to get inflation all the way back to 2% in a timely manner, especially if that goods deflation to the degree that we're seeing recently doesn't last, that this is just payback from the recent run-up since the pandemic? I think that remains a challenge that we'll be looking at in 2024.
What does a timely manner mean, right? Because this is something people have been talking about, and yet we have seen inflation come down rapidly. What's the tip point to where it becomes sticky, just de facto, ingrained in people's psyche?
Yeah, I think it's really when we see some of the initial unwinding of these pandemic effects. When do they seem to peter out, and what's inflation running at that point? So when you start to see perhaps that more stable picture for goods inflation, the more stable picture for housing, where do we have that run rate for inflation? What's happening within that core services? But I think the overall time frame is still up for debate, and that's something that we'll be looking at the Fed for clues at their meeting this week is what's the speed of that disinflation that they can live with, and what's still not fast enough where they're still somewhat worried about inflation expectations.
Sarah, my amateur take here is out west, rents are actually declining, like it's real. That's not happening on the west side of Manhattan. I can tell you that for certain. Help me with OER and the other housing, home, rental, home sale inflation statistics that you have. What are they signaling for, say, Q1 of next year?
Right, so we're seeing further disinflation in the pipeline for housing on that monthly basis. So we think that we'll see those shelter indices, the monthly pace, probably slow through probably the summer, late summer of next year. And then, so that'll carry forward in terms of the year-over-year numbers, and that shelter contribution continuing to contribute less through the early part of 2025. But as we're still seeing in terms of the monthly rates in some of the private sector measures, those are beginning to stabilize more recently, which suggests that disinflationary tailwind is likely to peter out as we get towards the end of 2024, renewing those questions around, well, where does inflation stabilize once we get through this correction over from this unique period that we've seen the past couple years?
And just to build on that, Sarah, we've been talking all morning about all the calls we've been getting, all of the full year 2024 projections that people are scripting and then planning to revise come January. I am curious, what's your highest conviction for 2024?
I think our highest conviction call is that growth is likely to be a lot worse than it has been over this past year. So our baseline is still a mild recession, but whether we get that technical recession or not, we think that growth is likely to be a lot slower, a lot weaker, as you still have the impact from a restrictive stance of Fed policy weighing on overall economic growth. The fact that we have seen the supply side help a lot in terms of bringing down inflation, but increasingly we're seeing signs of demand chipping into that dynamic, and we think that there's more of that to come.
Sarah, thank you so much. Sarah House is with Wells Fargo this morning. It's just stunning, the juxtaposition. Yardeni's an economist doing equities as well. Ms. House is just doing economics. But the difference between what we just heard there on slowdown and Ed Yardeni talking about the roaring 2020s, I mean, it is absolutely remarkable.
There are two different things here. First of all, is a question of whether a slowdown is going to be punitive or just set the stage for the next leg of the rally. That's what we heard from David Balin last week from Citigroup, right? That basically this is setting up the next leg of a rally. To me, this is really the ultimate question. You can have the same economic call and a different market call, especially given which companies have led and which companies people expect to keep leading, which is big tech.
So if I've watched 42 minutes of Bloomberg surveillance this morning, I'm going, okay, wise guy, how do you get a Stolfus 5200 SPX, whatever that is, Dow 37, 38, 39,000, whatever the number is. I got to work out the Yardeni number for that, just to upset Pharaoh. But the answer is, if you get that number, how do you juxtapose that or link that in to slowing GDP? I think a lot of people can't do that.
You know, this is where I think this is why it's been such a tricky market to talk about, right? That growth hasn't really led to a sense of what the equity market is doing. If you knew that growth was going to be 5% in the third quarter, would you look at the rally that we just saw as euphoria or just a logical progression from that?
We will have to see, and we'll see it with data. That was great, just to focus on inflation with one guest. We'll do that with all the different economic data we've got. Coming up, talk about the biggest shoes to fill on Wall Street. Max Layton takes over for Edward Morse on commodities at Citigroup. Stay with us.
I used to have a data point I used to share that 75% of the people had never heard a phone ringing. Just think about it. I didn't say had never used a phone. They'd never heard it ringing. Today, 75% of the African people have a mobile phone. They use one, okay? And we will do the same with the internet in the next 5 years. You know, we will do it as an industry, as entrepreneurs. All we need is the space, and we need investment support, because we are the best investment cases for this in the world.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Prices are right now, we do think that that likely increased the commitment from OPEC Plus, and you could see high compliance for that over 2 million barrels that they cut in the first quarter of next year.